JP Morgan kicks off earnings season on Wall Street with a beat. Fixed income trading comes in soft as expected, dropping 19% from a year ago. President Trump is wooed by the pomp and ceremony abroad. At home, Republicans struggle to put together a healthcare bill they can all agree on. And Brexit negotiations take one small baby step forwards. For the first time, the UK admits it will have to pay an exit bill. From New York City, good morning, good morning. A warm welcome to Bloomberg Daybreak on this Friday, July 14th. I'm Jonathan Ferro alongside David Weston and Alex Steele. Let's get you set up for the action this Friday. Futures are dead flat on the S&P 500. Euro with a slight bid at 114.14. Treasuries yield lower by a single basis point at 234. But front and centre are earnings on Wall Street, David.
So to help us go through these JP Morgan earnings, we're joined now by Charles Peabody, analyst with Compass Point, and by Allison Williams. She's a senior bank analyst with Bloomberg Intelligence. In a prior life, Allison analyzed the banks for UBS and Morgan Stanley. Welcome to both of you. So, Allison, let's start with you. We're trying to process these numbers as they come out, but it looks like a good story, I would say, just top line right now for JP Morgan.
So offhand, the first thing we look at, FICC and equity trading about in line, maybe like a touch light versus some of the estimates we've gathered. The net interest margin is something that I've been looking at. It looks like it came in lighter than expectations. The yield curve is something that everyone's been watching over the last quarter. JP Morgan has said in the past that it's really short rates that are more important to them. For a lot of the banks, it's more important to them, Citigroup as well, making that case. Bank of America actually had guided down. So the question is, were people paying attention to some of this? Because it does look like the interest margin coming in a little bit.
The interest margin is how much you make if you make a loan. They also,
Correct.
It looks like they're making more loans,
yes,
but they're maybe making it up on volume, as it were.
Well, industry, again, I think it probably has to do with the expectation. So we look at the H8 data. We have seen the industry loan growth is slowing. New to the guidance this quarter, it looks like they're talking about 8% loan growth for the year. I think we're going to want to hear more on the call about what they're seeing for clients in terms of demand. One of the things that Jamie Dimon has been very vocal about is tax reform and how he feels like that can help corporations. So we're going to want to hear more about that and how that factors into those expectations.
Charles Peabody around the table with us as well. Charles, your initial thoughts?
Well, the $1.82 clearly is a beat, but I think there's about $400 million of litigation reserve recovery. So that's 11, 12 cents a share, brings it down to $1.70. I was at $1.69. I was above the street. So it's kind of in line. Obviously, I'd like to see what the tax rate was and some of the other issues.
Guidance through the rest of the year pretty decent as well for loan growth, for the net interest margin too. What are your thoughts on that? Because compared to many of the analysts that we've had around this table, I don't want to call you a bear, but you've certainly been more bearish than the other guys around the table.
I think that's totally fair.
I've been skeptical about the earnings power and the sustainability of the earnings power. Yeah. And actually, I don't know if you can put up the EEG function for JPM, but if you look at that EEG function for JPM, you'll see that prices are going up, but earnings estimates are coming down. And so the marketplace is looking through the second quarter earnings towards Mnuchin's promised tax reform in September, towards the effects of the big buybacks in 18 earnings, towards infrastructure spending. So the second quarter earnings are being looked through.
There's the EEG function on the Bloomberg. The earnings have been looked through, but something you touched on was the importance of the CCAR results coming in to this earnings season, because the guidance for earnings from Marianne Lake, the CFO at JP Morgan, wasn't great. The guidance from many of these big banks on Wall Street wasn't great, but the price got bid up aggressively because of the buybacks and the dividends. Yeah. Do you have to fade that too? Can you really fade that?
Well, I think that the buybacks were certainly a positive surprise and will help earnings per share and ROE in 18. The thing is, I think they're going to be very, very vulnerable to changes in the macro backdrop. And that's what's new, is we'll let you have your buybacks, but we're going to cut them off if the macro buyback backdrop, sorry, turns sour on you.
Welcome to our world. I just want to recap the numbers for you if you're just joining us. So in terms of earnings per share, JP Morgan coming in $1.82, revenue coming in just over $26 billion. But the trading numbers, here they are. FICC down 19% year on year, coming in $3.2 billion, down $1 billion from the last quarter as well. Equities trading a little light, down by about 1%. But as we were discussing, core loan growth up 8% year on year. But you did have net charge-offs, about $5 billion. So you have the expectations for FICC are lower. You have JP Morgan down by 0.3%. Allison, where are we with net charge-offs and loan loss provisions? Because last quarter, that was the thing. I mean, you basically had credit card charge-offs were rising. You had charge-offs in general were rising. Where are we now in this quarter?
I think that is the thing that we're looking at, and I'm not sure offhand what the expectations are for charge-offs, but as you said, they're guiding for $5 billion of charge-offs for the year. I think investors are going to continue to look at the consumer side of things. The commercial side was where everyone was focused a year ago. We've actually seen a tailwind from that, from energy. We might get some questions this quarter around that, just given what's been happening with oil prices. But I think as people are looking forward, people are wondering about the card business, where there's just been a lot of competition. There's generally the card loan credit quality is tied towards income and employment, but excess supply can cause credit issues, as we know. Right. The auto sector is something that's so far the issues have been in subprime, but will that expand will that sort of expand and it tends to not be isolated when you have those issues. It tends to bleed over.
I should point out the credit card sales volume was up 15%. Charles?
Yeah. On that $5 billion, it's a guidance for the full year.
Okay.
All right. And that breaks down to roughly $4 billion of card charge-offs and $1 billion of other charge-offs. The thing you wanted to see in this quarter is, did card charge-offs come down a bit? Because that seasonally is what you would expect. And where in the first quarter, they enhanced their earnings by releasing energy reserves. Did that stop here in the second quarter? So you got an improvement in consumer, but a shift in corporate. That's what you wanted to look for.
As we look forward, we're now going to get Citibank earnings as well as Wells Fargo earnings. On the question of creditworthiness, as it were, FDIC is out with numbers that, at least in the auto area and credit cards, that actually default loans are really creeping up to multi-year highs, near those at least. Are we expecting increasing headwinds from that sort of failure?
The auto industry is not a big number for Citi, or even for J.P. Morgan. They're one of the bigger auto players, but as a bottom line issue, it's not big. So cards are the most important thing. And yeah, we're expecting deterioration over a cycle, but short term, the seasonals actually are better.
But the other question, Allison, I have is, autos may not be that big, but is that an indication of something that might bleed into other areas of credit? Is this an early indication that maybe the credit cycle is getting a little old?
And I think that's why people are looking at auto. I think that's why they are looking at card. So to Charles's point, so card is sort of the biggest area. And if you look across, sort of the big four, which are the companies that both Charles and myself cover, they're over-indexed versus the larger regional banking companies. They're over-indexed to card. They're over-indexed to consumer. They have less exposure to relative exposures to areas like C&I and commercial real estate. And that's why it's so important. And so the question around auto, there's some underwriting issues there. There's some other things going on. If you look at the overall general health of the consumer, and if you look at overall, credit broadly, including residential mortgage, it does look like consumers are really using wages to spend. They're not using credit to spend. But will some of the sort of aggressive, in card we have a lot of aggressive marketing, a lot of going after that. Will that start to translate into loan growth, and can that cause sort of a bigger problem down the road? So again, that's not a this quarter issue. I think what we're looking for is, are there signals of sort of trouble ahead?
Charles, I don't want to neglect the expected. The expected was this sharp drop-off in fixed income trading revenue. It was down 19%, and we shouldn't just ignore it. What I want to try and gauge from you as an analyst is how you plug in estimates of any given quarter going forward on what the trading environment is going to be like. Can you even do that?
I do. I try.
How do you do that?
Well, I follow a lot of the different asset classes very closely. I follow commodities, I follow currencies, I follow interest rate structures. And when you get, for example, let's look at junk bond spreads. When you get as tight as they are, and a normal spread is somewhere around 700, 800 basis points, there's going to be a widening based on what happens in the macroeconomy. And that widening could be very disruptive. And I think it's one of the things that Jamie Dimon was alluding to when he talked about the unwinding of QE and the uncertainty around that. And so I think we're looking at a very difficult fixed income trading environment in the second half of the year. And so I have very weak capital markets expectations versus the street, which assumes capital markets start off on a constructive note and then only adjust the numbers as the quarter progresses.
But on the margin, though, we know that. And it seems like in terms of low vol has been the criminal for it. But you see a pickup in high vol actually challenging the banks.
Yeah, the low vol.
It's counterintuitive. You think higher vol is going to be good for them for FICC.
Yeah, the bad volatility versus good volatility is broken down to 3 points. We've always talked about this. Thin liquidity gapping prices and whipsaw moves. We've seen the thin liquidity. We've seen reduced client engagement. We haven't seen the volatility in terms of gapping prices and whipsaw moves. And I think that's going to characterize more the second half of the year.
Allison, I feel like the other elephant in the room waiting in the wings is what we're going to do about deposit beta, what the banks are going to do, who's going to be the first mover, what it winds up meaning for revenue. Do we have any clarity on that yet?
So far, so good. And we probably are, maybe 1 or 2 rate hikes away to when we start seeing things really get interesting on that front. So far, things have, the beta has been lower than expected this cycle. And I think that's what most analysts had expected, just given sort of the environment where we were coming from.
Can I take an issue with that? She's right. So far, so good. But we're seeing the seeds for a deposit rate war developing. If you look at the non-bank system and you look at the rates being paid there, it's now 1.15 to 1.3%. Goldman Sachs Bank, Synchrony, CIT, it's the non-bank system that is starting to bid up deposit rates, and that's going to feed through to the banking system via the money market funds. So I think the seeds for a rate war are being planted right now.
Right. And to that point, what I was just going to say, and to that point,
well, let's go. All right.
To that point, what's different this time, as Charles is pointing out, is technology, right? So it's not just, this bank versus that bank on the corner. It's very easy to just go to your phone, see what the latest rate is. You have all these new competitors coming in, and I think, as I said, so far so good, but down the road, 1 or 2 rate hikes, things are going to get
You have to say, if they had a cartel, the benefit would be to get in a room and say, no war on deposits at all.
But the Fed's withdrawing liquidity, and that's going to make it tough for these non-banks to fund themselves.
And that would also put you in jail.
Yes, it would.
There is that little detail.
That's clearly illegal, David Weston.
It would be wrong.
It's just not in their interest to get into a war.
But if banks are paying 8 basis points, 10 basis points, and the non-bank are paying over 100 basis points, there's going to be a narrowing of that gap.
Yeah.
Guys, great conversation. Allison Williams of Bloomberg Intelligence, Charles Peabody, both will be joining us in the next hour to break down more bank earnings. We have Citi out at 8 o'clock. So it's time now for your morning brief as top U.S. lenders continue to report earnings throughout the morning. We get Citi at 8 as well as Wells Fargo. Then we're going to bring you an exclusive interview with Dallas Fed President Robert Kaplan right here on Bloomberg Television at 8:10 a.m. And in that hour, we'll also be on Data Watch for you. Get retail sales, CPI at 8:30. And then later in the 9 o'clock hour, we're going to get industrial production for June. So still data dump on the way, John.
Yeah, that's coming up through this programme. Coming up just around the corner, the UK accepting it must pay for the Brexit bill to depart the European Union. We'll be speaking to Pascal Donohoe, of course, Ireland's finance minister, weighing in on that topic next. From New York, for our audience worldwide, this is Bloomberg.
The bar for the Fed's next rate hike really boils down to inflation. Fed Presidents Lyle Brainerd and Robert Kaplan highlighted the need for inflation to get back to 2% while they assess further hikes. And Fed Chair Janet Yellen weighed in on her testimony to Congress yesterday.
We're very aware of the fact that inflation has been running below our 2% objective now for many years, and we're very focused on trying to bring inflation up to our 2% objective.
And in an hour's time, we're going to get the latest CPI numbers. And if it's low, that would be the 4 straight months of lower inflation. Well, joining us now is Stephen Whiting, Citi Private Bank Global Chief Investment Strategist. Stephen, great to see you.
Good morning. Yes.
How hard is it to the Fed to continue to hike rates if we get another miss today?
Look, it's not terribly difficult, but the scope of how far they go, their planning and their language about the future will depend, in fact, not just on this month's inflation data, but in the next couple of months. For them to be thinking about having to go all the way back to a neutral policy stance, in their view, whatever that may be, will depend on ultimately seeing some progress on getting up in inflation. And the problem with inflation, it's the macro fundamental that has the greatest inertia of all. And so it's very, very hard to sway trend inflation.
Right. And what we keep hearing is the temporary, the transitory. That's what we keep hearing over and over.
Right.
But if you take a look at, say, the Cleveland median CPI, that's also rolling over. And that's supposed to strip out things like telecom services, wireless services. So is the trend really lower? Like, can they still hide behind this temporary categorization? Despite
all of, the financial exuberance that we've had in recent years, the imbalances in the real economy in terms of supply and demand. The demand for goods and services is not greatly exceeding supply. We're very globalized. And there's a lot of capacity around the rest of the world. if we don't have it. And that's holding down inflation. I think 2% is not some, massively ambitious target. But it does suggest that at least if you were worried about, price inflation, that you should be considering staying on the accommodative side. The biggest problem with that, though, is do you build up bigger financial imbalances that you pay for in some future recession, which itself is a threat that could be deflationary. And that's the sort of thing that they grapple with right now. And it suggests that they go very slow. And I think it should give the markets some confidence, again, that they can move very, very deliberately and watch what happens, the interaction between the economy and their policy.
Stephen, we just heard Janet Yellen admitting in Congress that she hadn't been too successful in getting 2%. I want to put up a chart, actually. Our colleague Carl Riccadonna put this together, which illustrates this pretty graphically. That yellow line is the 2%.
Right.
And this is over the last several years. You can see what's happening, whether it's core PCE or it's headline inflation. At this point, what is the relationship between monetary policy and inflation? I mean, on the one hand, do we believe that keeping it accommodative will ever get it back up to 2%?
What is the relationship between our labor market and inflation? I mean, even something that is more closely aligned, because demand for labor is a real economic fundamental. But, we had this very, very long period of remarkable slack in our labor markets and a period that sank inflation even lower. We've had a lot of strength in the U.S. dollar in the last 6 years, even though it's come off this year. And these are all forces holding back inflation right now. Again, but the basic problem is that do you create financial imbalances for the future that you could pay for with an even lower inflation rate potentially down the road if you don't have a more neutral financial setting? And so that's what I think that they struggle with. But again, it does give them room to go much more cautiously here, particularly as they approach, and they seem to be, very clear on this, that they want balance sheet adjustment. They don't want to own a larger bond portfolio than they absolutely need. So pursuing these things at once could end up stretching out this period of bringing monetary policy to a tighter stance.
So as we wait for those CPI numbers coming out in a short time from now, what is the balance between the balance sheet on one hand and rates on the other when it comes to inflation? I mean, if there's a fourth month that's soft, that will send some message to somebody someplace. Yep. But does that mean you can afford to come up on the balance sheet some more rather than the rates?
Look, if they ended up with nothing but downside surprises to inflation all year long, they'd probably put balance sheet adjustment off until next year. But, and again, if the economy were not unfolding in a path that was upward in terms of consumption and investment, that would change things too, and they wouldn't be tightening at all. But so these are the sorts of things that I think that they can't so easily calibrate. They have, I think, succeeded very much by taking the fangs off of balance sheet adjustment, by communicating it so clearly and systematically, like we've seen in the past, that it minimizes the impact on volatility. So they're trying to tighten in a very, very, very cautious way. And it could be even more cautious than this.
Let's talk about something a bit more subjective. Conviction. Did you sense that the Fed chair was losing her conviction somewhat over the last couple of days?
Not too much. I think the acknowledgement. I think that we were in a period listening to central bankers and not just Chair Yellen, where the outlook seemed to be on autopilot. Okay, this is what we've got to do. This is where we're going. I don't care about the facts. And in the meantime, I think it was good to see her just acknowledge, where they are on the inflation front. You cannot argue that the labor market is not improving. And I think it certainly is. And if you were to improve faster than this, you'd worry a little bit about, burning out a little too fast.
Do you think she'd be unhappy about a dovish interpretation of her semi-annual testimony, given their concerns over financial stability, and given that actually after her comments, stocks hit another record high and then they hit another record high?
Yes, I'm speculating on her position, but the fact that financial conditions are easing while the Fed is tightening, is not entirely desirable. But you have to remember, again, that they are not hitting on both of their mandates right now. They are attempting to be extremely gradual. It would be a wonderful thing if the economy could grow with low inflation and financial asset prices discounted a good, solid recovery in the future, wouldn't it?
Yes, it would indeed. Okay, Stephen Whiting of Citi Private Bank is going to be staying with us. Coming up, Pascal Donohoe. He is Ireland's finance minister. He's going to be weighing in on the cost of Brexit for Ireland. Live from New York, this is Bloomberg.
The
This is Bloomberg Daybreak. I'm Emma Chandra with your Bloomberg Business Flash. EasyJet is creating a new Europe-based airline to operate flights after the UK leaves the EU. The subsidiary will be called EasyJet Europe and will be headquartered in Vienna. The move is designed to ensure EasyJet's routes within the European Union are shielded from any fallout from Brexit negotiations. There's a changing of the guard at Vanguard. The world's second largest money manager says Chief Executive Officer William McNabb will step down at the end of the year and cede his role to Tim Buckley. Under McNabb, Vanguard more than tripled in size, overseeing $4.4 trillion and the savings of more than 20 million investors. AT&T is dialing up organizational changes following its $85 billion acquisition of Time Warner. People familiar with the matter say Randall Stevenson will drop the CEO title he's held for 10 years to become executive chairman. In that role, he'll oversee a pair of CEOs who will independently manage the company's telecommunications and media businesses. And that's your Bloomberg Business Flash. Now to Alex for some movers.
Let's start with the story of the day, and that is bank earnings. So JP Morgan now up by 0.1% in pre-market. It was up by about 1%. So the FIC number, that's the biggie, right? That was down 19% year on year, coming at $3.2 billion, $1 billion less than what we saw in the first quarter. But I want to dig into their loan growth portfolio. So their core loan growth was up by 8%. And due to that, their reserve build was about $425 million. Yes, part of that was because more loans, but also because of a higher loss rates, especially in the card business. And in particular, its profits in the consumer business were down 16%. Provisions in the consumer bank were up 16%. So we're going to have to dig a little deeper, especially on the call, to see what their read is about the consumer, as well as the credit quality and where we are in the cycle. And Citi is on deck for 8 o'clock as well. That stock now up by 0.2%. The estimates are for $1.21 a share, looking for that FIC coming in at $2.9 billion. Other stocks we want to pay attention to, unrelated to bank earnings, is Walmart. That stock up over 1% in pre-market. Got an upgrade to buy from neutral over at Goldman. Added to the conviction buy list, says, hey, it's well positioned as any other retailer to handle Amazon's increased consumable focus. Go figure. Cites small market focused, inventory discipline. Of course, these guys have just really been hammered and sort of squeezed out when it comes to Amazon. But an upgrade there from Goldman Sachs. But really, John, it's going to be about those bank earnings. I mean, then we get Goldman, Morgan Stanley next week as well. All eyes on FIC and what they're putting aside for loan issues.
Very much so. Another two still to come this morning. Looking forward to it. Coming up a little bit later, don't miss this one, an exclusive conversation, an interview with Robert Kaplan, Dallas Fed president, will be joining Bloomberg's Tom Keene, I believe, at 8 a.m. Eastern. From New York City, getting you set up for the market action this Friday. Let's whip through things for you. Futures go nowhere on the Dow at a record high. The S&P 500 grinding towards a second week of gains. On the other screen, this is how the bond market's set up for you. Treasuries yield to lower by a single basis point at 233 on a 10-year. You're watching Bloomberg. From New York City, for our viewers worldwide, you're watching Bloomberg Daybreak. I'm Jonathan Ferro. Let's get you set up with a market action, shall we? Futures go nowhere on the Dow after another record in yesterday's session. The S&P 500 dead flat as well. Not much price action across the continent over in Europe either. If you get to the other screen, about an hour away from some important economic data here in the United States, retail sales and CPI on deck, 60 minutes away. Treasuries yield starting the week at 238, 239, just grinding lower over the last 5 sessions, 233 on a US 10-year. We come in another single basis point. In the FX market, more broadly in the G10 space, a weaker dollar theme emerging. The cable rate coming up to 129.76, euro dollar 114.17, up about 0.2%, David.
Well, Jonathan, as was promised, we got the Senate Republicans' redo of their health care bill yesterday, and from the reaction, it seemed like there was something in it for everyone to either love or to hate. Joining us now is our chief Washington correspondent, Kevin Cirilli. So, Kevin, just to start with the numbers, they have 52 Republican senators. They can only afford to lose 2, and almost immediately 2 came out and said they're voting against. How are they doing?
Well, and then there's a host more, David, that are undecided. People like Senator Dean Heller, Senator Lisa Murkowski, Senator Susan Collins, Shelley Moore Capito of West Virginia, Rob Portman of Ohio. There is a large contingency right now of folks who are very much undecided for very different reasons. There is no room for error on behalf of the majority leader. Now, President Trump is overseas right now in France, but he also was tweeting this morning urging Republicans Republican senators to fall in line behind Senate Majority Leader Mitch McConnell to do this. And he has essentially said that the vice president has worked very hard in order to try to get this done. So important, Republican senators under leadership of Senate Majority Leader McConnell get health care plan approved after 7 years of Obamacare disaster must happen. Those from the latest tweets. I caught up with Senator Bob Corker yesterday, a Republican from Tennessee, someone who also seemingly is supportive of this plan, but it does include not repealing some of those taxes. Take a listen to what he told me when I asked him about the keeping of the taxes.
What it really does is keep a revenue base in place. Tax reform will deal with what type of taxes should or shouldn't be in place. So I don't think anybody should look at the particular types of taxes, but just look at that as a revenue base.
So there you have it. Of course, lawmakers such as Senator Corker saying, let's get through health care, David, and then we can get to tax reform.
Okay, so let's get to tax reform. Just as we leave you, leave us with a thought on tax reform. Yesterday, we got the CBO scoring we've been waiting for on the budget, which basically said we can't really tell. There's not much detail in there. We think you're way too optimistic on your growth, but you are going to cut the deficit a bit over 10 years. Is this going to help tax reform, hurt it? How does it affect it?
It's interesting that folks are now, the Republicans are saying they like this CBO score while absolutely lambasting the CBO score on healthcare. Does it help a tax reform? I think that it does. But again, they cannot get to it unless they first address healthcare. There is no appetite for them to be juggling two issues right now, at least within the next couple of days before August.
Okay, thank you much, Kevin Cirilli. We're going to be coming back to you during the program. After such high hopes for business and markets after Donald Trump's election, things have settled down quite a bit, I think it's fair to say. But is there still room for some upside surprise out of Washington? Steve Whiting of Citi is still with us, so is there?
I think that you can't rule out that there can be surprise from Washington. Politics is surprising all the time. And I think that what markets have become used to over this half year, that nothing can get done, suddenly when something gets done, it's a much more substantial surprise. So if you think that the impact that tax cuts, potential trade issues, all of these positives and negatives, depending on your perspective, had from November through January, all of that is faded out of the marketplace. And so it's a very, very small notion in the marketplace, a small risk that there will be some substantial U.S. fiscal stimulus, for example. And it could change things. It could come, and it could be a much more substantial surprise. Doesn't mean that the probability is, as high as it was. It seemed to be at the turn of the election. It doesn't mean that the size of any package is going to be really move the needle very much, but it's now priced out of the market.
So what's going on in Washington is almost like catnip for journalists.
Yes.
But what about for investors? What about for business people? I mean, are they spending much time focused on what's going on or not going on in Washington?
I think that there is just considerably less focus on it. I think that the good news has been that the world economy was more resilient, stronger, in fact, and that interest rates, exchange rates, all of these things that could be moved by U.S. policy, just less disruptive for the world. And so the focus has moved on. Now, again, we could come back to it, but we're not going to have the kind of disruptive and incredibly positive effect on domestic economic activity and disruptive for the rest of the world because we've scaled back considerably the scope for action.
Here's what I don't get, though, is after President Trump was elected, it was go long equities, short treasuries, and buy the dollar. We've seen the trade for the dollar and treasuries reverse, but not for equities. How do you explain that?
It's different kinds of equities. And again, small cap, domestic focused stocks, companies with, very high tax rates. Have not been outperforming those of low tax rates. Companies with large amounts of overseas cash, have not been performing any differently. So these sorts of metrics tell us that we have substantially priced out, and much more so. The exchange rate is telling us that we've priced out, U.S. dominance type trades based on, some big fiscal plan.
But at the same time, I'm looking at the Russell 2000 index, and it's still right around record highs. So I wonder how much is still baked into names like that. On the flip side, trade wars seem to be bubbling up again, so that sort of dents the multinational thesis.
Trade wars bubbling up again. We've had a nominal trade agreement with China on energy and agriculture instead of, big trade sanctions. NAFTA isn't falling apart. And I think if you just look at the overall backdrop, this is probably a first half U.S. earnings tape of 12% EPS growth. The whole backdrop in many ways has changed, has been more positive than expected. And that's going to have some influence away from the waxing and waning in Washington.
All right, Stephen Whiting of Citi Private Bank, you're going to be sticking with us. And coming up, the UK accepts it must pay for the Brexit bill to depart the EU, the small steps that we're making here. Ireland's finance minister will be weighing in on that next. This is Bloomberg.
This is Bloomberg Daybreak. I'm Emma Chandra here in the Hewlett-Packard Enterprise Green Room. Coming up in the next hour, an exclusive interview with Dallas Fed President Robert Kaplan. That's at 8 a.m. Eastern.
From New York City, with a focus on Brexit now, for the first time, the British government has conceded on paper it will have to pay a bill to leave the European Union. Brexit Secretary David Davis referred to a financial settlement in a statement to Parliament. Joining us now is in an exclusive interview in London is Pascal Donohoe, of course, Finance Minister of Ireland. Minister, great to have you with us on the programme. We appreciate your time. Let's just start with this Brexit bill, shall we? Reports of a number north of 100 billion. Have you got any idea over in Ireland what kind of numbers we're talking about here?
Well, what the European Union wants to do, which Ireland is fully supportive of, is engage in a set of processes in relation to that first, which at the end of that process will then yield a figure. This is, of course, a matter that's very, very important to the European Union and to the British government. And I think what's crucial at this stage now is that both parties engage in a process that will yield a figure at the end of it.
Minister, I appreciate you used the word the European Union is very interested in this. Where's Ireland's interest in this particular topic? Are you worried that maybe you'll have to plug quite a big budget deficit, a big budget gap over in the European Union after the UK leaves?
Well, look, there's a range of different economic consequences that are going to occur as a result of Britain leaving the European Union, one of which will be the impact on the budgetary environment of the Union and Ireland. From an Irish perspective, we're participating in this as a member of the European Union. And yes, the financial consequences of this in terms of budgetary impact are very, very significant. But what is as important to us is how we can develop a trading relationship with the United Kingdom in a post-Brexit UK, and also how we can deal with issues in relation to movement of people between the United Kingdom and Ireland. There are also issues that are very important to us in the context of the peace process in Northern Ireland. But we're engaging in all of these issues as members of the European Union. Minister,
let's pick out one of those issues one time, and then we'll get to the other one. Let's begin, though, with the prospect that Ireland actually could be quite hard done by from the UK exit from the European Union. Would you be looking to seek any kind of aid package from the European Union to compensate you for what may happen on the other side of that exit?
Well, when the nature of the exit of Britain from the European Union becomes clearer, the Irish government have already indicated that we want the consequences of that to be recognised within the European Union. But what we're also doing, though, is looking at what steps that we can take, that we can with the resources that are available to us to deal with this issue. So we're now engaged in a process of looking at how we can strengthen our own investment into Irish capital, like our universities, our public transport, to make our country even more competitive in the future. And we're looking to do that through a 10-year plan for our own country. And of course, we have an ongoing focus in Ireland in what we can do to ensure our economy is competitive, to ensure our tax rates are competitive. And as a result of that now, over the last number of years, we've seen over 200,000 jobs created in our economy. And we're committed to continuing with that work, while also within the European Union making the point that from a trading point of view, will be the most adversely affected.
Well, let's start from the top down, from the trading point of view, and then I want to get into the financial hub that could be Dublin as well. From a trading point of view, if the EU can agree to a free trade agreement with Japan, why can they not do the same thing with the United Kingdom?
Well, we've had a process with Japan underway now for many, many years, as we've had with Canada, as we've had, for example, with South Korea. So this is a process that has been underway for quite some time, in which the competence of it is assigned to the European Commission, who negotiate on our behalf. But I think both the European Union and the United Kingdom have said that a matter of future engagement will be, after the current parcel of items are dealt with, will be what the future relationship will be between the UK and the European Union, and clearly the issue of trade will be central to that.
Minister, I understand that it takes time. Good things take time. I get that. But the approach so far seems to be very political. It seems to be about punishing the United Kingdom because the electorate voted to leave. The sensible economic approach is to agree what was agreed with Japan. So theoretically, from Ireland's perspective, is your message to Europe, get on with it and agree a free trade agreement with the United Kingdom?
Well, the outcome of the trade agreement with Japan, and I hope it is ratified, is actually driven by political objectives and principles. It's driven by the understanding that trade, when it's free, when it's properly structured, is mutually beneficial to all. There is no intent whatsoever within the European Union to be engaged in a process of punishing the United Kingdom. As a country that has referendums ourselves very frequently in Ireland, we respect the decision of the British people expressed through the referendum, and the European Union recognises that too. In terms of the pace of negotiations between the EU and the UK, as I've said to you in a number of times now, we're participating as members of the Union, and we think what's important is that we have negotiations that are successful rather than negotiations that have, a particular time frame set against them. Under the triggering of Article 50, the negotiations have to be concluded by a particular point. But what we've always said is we think it will become increasingly important to look at the issue of transitional agreements to see how the British economy and then the European economy can move to a new landing point in the next few years.
Mr. Donohoe, take us into the mechanics of the negotiation on the European side. As you say, you want successful negotiations, but each country has somewhat different relationships with the UK right now. And as you've pointed out, Ireland is really in some ways literally on the front lines with the only land border. Behind the scenes, how do you have input into the negotiating position for the European Union? How do you affect Mr. Barnier? And are there other countries that are more or less aligned with you in what you think ought to be done?
Well, I think that's a nice way of expressing it there in terms of the mechanics of how these negotiations will evolve. Within Europe, we have the Commission, which is an institution within the European Union, and they have particular roles that they perform on behalf of all member states of the Union. And what all the existing members of the European Union have decided is that we will allow the Commission to negotiate on our behalf. In terms of how we engage with the European Commission then, it's done through regular contact from government with the Commission. So, for example, this week alone, I've met 2 different commissioners who will be involved, who are central to the European Commission and the work that goes on. And on Monday, our Deputy Prime Minister met Mr. Barnier. So we've ongoing contact at the highest level politically to the Commission to emphasise the particular concerns that we have.
Minister, you'll appreciate that we're at the mercy of news flow, so I just want to deal with some breaking news very quickly. We have earnings from Citigroup out. Second quarter EPS comes in at 128, the estimate 121, so an upside surprise there. Second quarter revenue comes in at $17.9 billion, the estimate 17.4. FIC trading, markets revenue comes in at 3.215, the estimate was 2.976, so a decent upside surprise across the board at the moment coming from Citigroup. I'll get to the detail in just a moment. Minister, I do want to talk to you about the financials and some of those big banks in the United States. What is Dublin and Ireland doing to attract the banks to move across from the City of London? And have you been disappointed by the Brexit dividend that maybe Ireland would have got?
Well, we already have a very, very significant financial services industry in Ireland, and in fact Dublin is one of the financial services capital of Europe. And far from being disappointed at progress we've made to date, we believe we're making very, very solid progress in getting more than our fair share of the consequences of Brexit here within the United Kingdom for financial services. We've seen, for example, JP Morgan now make a very big investment in Ireland, building on what they already have, looking to create more jobs there. And we expect very soon now you're going to see further announcements in that area.
You successfully sold off 25% of Allied Irish banks in one of the biggest IPOs in Europe, actually, this year. I understand you need cabinet approval to sell more before the end of 2018. Given the bank's strong share price performance since the IPO, how likely is it that you'll seek that approval anytime soon?
Well, from a legal point of view, we can't sell anything else in 2017. We're in what's called a lockout period because we've sold over a quarter of the bank recently for €3.4 billion. In terms of any future disposals within Allied Irish Bank or any other parts of the Irish banking sector, we'll evaluate market conditions continually. And we'll see are there opportunities for us to make our banking sector more sustainable and release more value back to the taxpayer. If that happens, as you've just said there, the process is that I go back to the Irish Cabinet, but I'm not expecting I'll be doing that imminently.
Minister, before we leave you, I just want to wrap things up with this issue of competitiveness, which is a topic that you've brought up yourself a couple of times in this interview. The President of the United States would like to slash the corporate tax rate right here in the US. What are your thoughts on what that means for the competitiveness of Ireland, given that significant advantage that you've had for many US companies looking at your very competitive tax rate?
Well, first and foremost, that's a matter for President Trump and the American political system to decide what they want in relation to their own tax code. But looking at any changes that may happen, we're absolutely confident that we have a competitive offering broadly across our country that can withstand any such changes. What we have in our corporate tax code is a very long-standing response to the scale of our economy and where we're located as an island on the edge of Europe. But we now have to offer so much more alongside that in terms of the youth and education of our country, in terms of the infrastructure within our country and what we can offer investors that want to come to our country. So because of all of those different decisions over recent years, we're confident that Ireland will continue to offer a very, very competitive offering to international companies that want to come to Ireland, not to mention the huge number of Irish companies that are now prospering in a growing economy.
Paschal Donohoe, of course, Ireland's Finance Minister, joining us from London. Really appreciate your time, sir. Thank you very much. Back to the mercy of the news flow. Alex Steele, Citigroup.
Yeah, I'm taking a look at Citigroup here. That stock was modestly lower in pre-market after earnings. So here's the deal. 128 earnings per share. Revenue, almost $18 billion. Let's get to the juicy numbers. You got FICC revenue down 6%, but it was a beat versus estimates coming at $3.2 billion. Equities down 11% year on year, but investment banking kind of crushing it year on year. You wound up having institutional clients had a really strong quarter. It was the best IB performance in 7 years. Also good commentary here, guys, on consumer banking loans. You have global consumer banking revenue is actually up 5%. Deposits were up, loans were up, and allowances for loan losses were down. So that feels like a different story than what we heard from JP Morgan. More loans, but not setting aside more for loan losses. So an interesting dynamic there, and we'll be discussing throughout the next 2 hours. If you have a Bloomberg terminal, check out TV Go. Watch us online, click on our charts and graphics, interact with us directly. Just go to TV Go on your terminal. This is Bloomberg. All right, bank earnings trickling out this morning. You had JP Morgan with a beat. Citigroup just out as well. The earnings coming in for Citigroup at $1.28 a share. Revenue coming in almost $18 billion. FICC was down year on year, but up versus estimates. Equities down year on year, but investment banking performance was the best in 7 years. Back with us, Charles Peabody of Compass Point. Your reaction to Citi?
Well, the numbers certainly are stronger than expected. The revenue number was in line, so I'm trying to figure out where the beat was. But certainly the investment banking, we were looking for about $1.2 billion, and then trading, we were looking for about $3.7 billion. So I haven't seen the numbers yet, so I'm not sure.
Right, we're going through the press release right now. What I also thought was interesting is that their global consumer banking revenue was up. As well as their loans, but their loan losses were down slightly year on year. That feels like a different story than the headlines we got out of JP Morgan. Is that a fair assessment to make?
Yeah, I mean, they've been talking about generating positive operating leverage out of both Mexico and Asia and the consumer bank. The North American bank, they've been looking for the second half to be where the story really starts to build because of the card business. And so what you want to look for is there something in the card business in this quarter that's showing a momentum into the second half?
Are we finding out from these earnings, though, that higher rates have helped bail out a really weak trading environment on the quarter?
Well, not in the case of J.P. Morgan. That was the big disappointment in this quarter. They had guided net interest income or top-line revenue to be up $400 million from the first quarter. It only came in up $100 million. For the full year, they had guided $4.5 billion increase, and now they're lowering that guidance to only a $4 billion increase. So NII was a disappointment at J.P. Morgan.
What's your base case through the rest of the year now?
Well, I think this gets back to the core businesses, and the core businesses, I don't think, are showing a lot of momentum. Whether you're talking about cards, mortgage banking, lending, although J.P. Morgan did have 8% loan growth, and even the capital markets, although Citi obviously was stronger than expected.
Is it too early to make an assessment of who's going to be the best to capitalize on higher rates and loan growth and manage any sort of charge-offs and credit issues?
Well, I think we're at the point of diminishing returns in terms of higher rates. And you saw that in J.P. Morgan's quarter. I think you're going to see that in Bank of America because they've been lowering expectations for top-line revenue growth. So I don't think higher rates are the big story going forward. And I think the deposit beta rate war has a tendency to pick up at this point.
So, Charles, is there a certain irony, at least in the numbers as I'm looking at right now, where you think about Citibank, you think about cards, and you think about international. There's two things that distinguish them. That doesn't seem to be at the top of these earnings. Actually, it's investment banking, which you don't normally think about Citibank on. And even in the FICC trading, they did less well than last year, but they came in closer, much closer than J.P. Morgan, for example, and better than what they'd estimated. So, ironically, that seems to be driving it.
Yeah, I mean, Citi's got one of the best FICC platforms in the business, and that is their core strength. Where they need to improve is on the equity side. I mean, I haven't seen those numbers.
Well, they were off 11% year over year. It was down 6% in fixed income and 11% in equities.
Charles Peabody, we've got to leave it there. You're going to stay with us, though. Thank you very much, sir. We'll get those bank earnings wrapped up for you in the next hour. Joining us as well, Jean Médecin of Carmignac Gestion. From New York, you're watching Bloomberg. JP Morgan and Citi kick off earnings season on Wall Street with a beat, but the signs emerge that the bond trading comeback is at risk of stalling out. President Trump is wooed by the pomp and ceremony abroad. At home, Republicans struggle to put together a healthcare bill they can all agree on. And Brexit negotiations take a small baby step forwards. For the first time, the UK actually admits it will have to pay an exit bill. From New York City, good morning. Good morning. This is Bloomberg Daybreak. I'm Jonathan Ferro alongside David Weston and Alex Steele. And Alex Steele, another bank with another set of earnings.
Yeah, so here's Wells Fargo. Their earnings coming in at $1.07 a share. It looks like a beat. The estimate was for 101. But the number that I'm really interested in is the provisions for credit losses are just about $555 million. The estimate was for over $800 million. And credit provisions for the last quarter, $605 million. So that seems to be better in terms of their credit losses. That stock, though, still down by over 1%. The numbers, of course, we're really going to look into is what's happening to their mortgage, what kind of loans they're seeing, mortgage paydowns and auto loans, looking through those numbers, and we'll bring them to you as they cross.
Let's bring the team in, shall we? The Wells Fargo earnings, Citi and JP Morgan. We're joined by Charles Peabody of Compass Point and Alison Williams, our very own senior bank analyst over at Bloomberg Intelligence. Alison, let's begin with you. What jumps out?
So looking quickly, and net interest margin, I think, is the thing we're looking for after J.P. Morgan's sort of notable miss. PNC, a regional bank focused, coming in better than expected. Wells Fargo also 1 basis point better than expected. Keep in mind they have some hedges going on there. Credit also coming in better than expected. So that's a key positive. If you look at their charge-offs, less than expected, but we are going to want to dig in and see where that is. J.P. Morgan, we also saw charge-offs better than expected, and I thought that was something that's interesting. You know, interest income, that's been the bull case for banks, a miss. Credit, that's the bear case for banks. They beat, however, card charge-offs, something we were talking about earlier, actually looks like credit might be weakening there. So I think that'll be more of a focus than the overall credit. Similar to Wells Fargo, you know, people are going to give less credence to a beat based on better energy, which was an issue last year, and more credence to what's happening on the consumer book, I think.
Charles Peabody?
I think Allison hit it on the nose. And with the caveat, I don't follow Wells Fargo. We were expecting seasonal improvement on the consumer credit. The question is what happened on the corporate side. And if were you implying they released some energy reserves on the corporate side?
Well, it looks like charge-offs were lower, so charge-offs themselves were lower, so it would be more than just releases. The provision 555 versus consensus 804, charge-off 655 versus 793. So.
I also noticed that in terms of the
like
earnings per share, you always have to be careful year to year because every apples and oranges. 4 cents of it apparently was from a tax adjustment. So that 4 cents of it, so it comes in closer to what the consensus estimate was. But do we have numbers? I haven't seen them yet, Allison, on loan origination.
So I haven't seen them yet.
Yes, actually, I got them for you. Allison, they just came across here. So total average loans are up by 1%. So they were up by about $6.1 billion, up to about $956 billion.
So that's relatively modest.
And I should point out deposits, though, are also up 5%. But still, there's growth.
Well, the deposits are important, though, Allison, particularly for Wells Fargo, right? I mean, one of the questions is the continuing consumer relationships, because they are really a retail bank. And the concern by investors has been, are they going to be able to hold on to all those depositors?
It is, and I think two of the things that investors are looking at for Wells Fargo, the cost side, I'm just seeing that their cost ratio is coming in at 61%. That's about in line with the expectations after they basically had sort of guided to a higher ratio at their investor day. Part of that does relate to the sales misconduct issues of last year. I think people are also going to be looking for those retail metrics. We were getting monthly updates for a while in terms of tracking that improvement, and so I think investors are going to be looking just to see that they are continuing to come out of that.
Charles Peabody, there was a big concern about loan growth across the board on the corporate side, the consumer too, through the rest of this year. What have we learned this morning so far?
Well, the loan growth continues, but it has slowed incrementally. But it continues at a low single to mid-single digit rate for the industry as a whole.
Coming into the year, confidence right up here. A lot of people plugging in some big estimates. What's your base case compared to the median estimate on the street?
Well, I think you're seeing the soft data starting to roll over closer to the hard data, which remains sluggish. So I still think we're in a muddle-through economy, 1.5–2% type GDP.
So loan growth is up modestly, Charles, but actually issuance, new corporate issuance, is down somewhat. We have a chart here to show that it's actually coming down a bit. Does that give us some warning signals about where we're going?
Well, I think there is a lot of hesitancy about what the future policies are going to look like. And if you're a CEO and you're trying to, plan on a 5-year project and you don't know whether the tax rate is going to be 25% or 20 or 28, it's hard to make that commitment right now. And you don't know how long it's going to be in place, because if it's not, that tax cut is not paid for, it could sunset after about 3 years. And your payback on a lot of these projects are 10 years. So it's hard to make commitments. And I think that's showing up in the weak C&I loan growth.
Allison, what was interesting in the past few quarters is we could kind of paint banks with a broad stroke, right? Weak FIC. The divergence was just last quarter with Goldman, right? Are we in an environment now where we're not going to be able to paint the banks with one broad stroke, but it's really going to be the idiosyncratic stories?
Well, I think, there's always broad trends that are going to impact the banking sector, right? So U.S. GDP is going to always be the key driver of the overall earnings growth. And then when we look at the bits and pieces, it really just depends on the bank's positioning, right? So U.S. interest rates, that's going to help Bank of America the most. FIC trading, which is something that was weaker this quarter, but that's much more important to Citigroup than it is to some of the other companies. And they actually came in much better than expected on that front.
Charles?
Yeah, I have the net interest income number for Citigroup, and it came in around $11.2 billion, which was down 1% year over year, but up 3% sequentially. That's kind of in line, but weak. So there seems to be, within the money centers at least, some indication that top-line revenue growth is not as strong as expected.
Set me up for next week. Goldman Sachs coming out too. What are we expecting from those guys next week, given what we know from the banks that have come out this morning?
Well, the big issue is going to be what happens on the trading front. And both Goldman and Morgan Stanley have been fairly aggressive in lowering expectations on that basis. The one thing that differentiates, let's say, a Goldman from a Citi or JP Morgan is Goldman doesn't carry a lot of FIC product in inventory, so they don't get as much benefit on NII from that carry, whereas the big banks do. And I'm trying to figure out if JP Morgan's shortfall in NII was related to their trading book at all.
Well, on the FIC trading revenue, what we learned in the last quarter as well is the importance of the client mix, whether you have a more institutional base or whether it's a more corporate base, whether it's the hedge funds or whether it's companies issuing debt and raising capital. With that in mind, with the quarter that's just been and it's behind us, the earnings next week, set me up.
Yeah, I mean, and that's you'll see in Citi has a very strong relationship with the corporate client, which is very active this quarter, whereas Goldman is much more active with the hedge fund or the bank or broker, which have been less active this quarter. And maybe that explains Citi's strong investment banking activity is their strong corporate relationships on the fixed side.
Sustainable, Allison?
So, well, we'll see next quarter.
Oh, come on. I did the answer. But we had that question with FIC, right? When FIC was really killing it, the question is how sustainable is it? So when we turn to IB, how sustainable is it?
I think it is the question of, it is the question of sort of what is the driver. And we talk a lot every quarter about like market share. I know this one's gaining share, or, missing. But, to Charles's point, a lot of it really has, and to your point as well, a lot of it is mixed, right? So if corporate clients are outperforming, you're going to see it in Citi's results. If commodities has a huge quarter, that's going to help Goldman more than everybody else. When it's weaker, that's what we saw last quarter. We could see some issues this quarter. They're going to underperform.
Listen, investment banking trading tends to be seasonally weak into the third quarter. But a lot could change based on the central banker comments. And they're flip-flopping back and forth, which is really confusing the market and is why people are staying out. A lot could change, I think, around Jackson Hole if Yellen makes some very strong statements about the future.
Allison, we've heard for years now that the problem with the banks is the regulation. Does any of these results, would they be affected by less regulation? I mean, if there isn't the demand for loans, it doesn't matter how many reserves you have to hold.
So I think that the big thing that I think investors and bank managements are looking to for a policy perspective is tax reform. It's something I'm sure we're going to hear Jamie Dimon talk today about. But and that's not necessarily a direct impact, but an indirect impact. What would that mean for the economy? What would that mean for investors? From a specific bank regulatory standpoint, obviously people got very excited after the election about change. I think investors are learning that those changes are going to take time. We did get a positive indication with CCAR and the higher payouts, but some of the changes that investors are hoping for are not going to be as immediate as perhaps they had been optimistic about.
Okay, Allison Williams of Bloomberg Intelligence and Charles Peabody of Compass Point, thank you both very much for being here. Coming up next, we're going to talk to the man you want to hear from between, on the one hand, Chairman Janet Yellen. It's going to be Robert Kaplan. He's Dallas Fed president. We're going to be talking to him exclusively, and this is Bloomberg.
Could happen, David.
Yeah.
From New York City for our viewers worldwide, let's just whip through the market action very quickly. Stocks dead flat ahead of the open. If you're looking at futures, that's the situation. For now, we can cross over to Bloomberg's Tom Keene, who's standing by with a special guest.
Folks, we speak with Robert Kaplan of the Dallas Fed. We welcome Bloomberg Television Worldwide into our Bloomberg Radio studios here in New York. And, of course, President Kaplan is in Mexico City, an important part of a Dallas Fed mission. Let me begin, Robert Kaplan, with the idea of why you're in Mexico City. You and I know the research heritage of your Dallas Fed, of our southern border. Did you have to climb a wall to get to Mexico City today?
No, didn't need to climb a wall at all. No, we have a very long-standing relationship at the Dallas Fed with the Central Bank of Mexico and with senior government officials of Mexico. So I come here regularly, and officials from Mexico come to the 11th District regularly. But this is a very important relationship.
Yes.
Texas is the largest exporting state in the country, and Mexico is our largest trading partner.
Have your good PhD, the legendary Dallas team, the PhDs there, have they quantified what a Trump wall would mean to the GDP of Mexico or to Texas and the 11th District, or for that matter, to America?
Well, let me state it more positively. What I'd say the two key points are: one, the trading relationship between the United States and Mexico, I think, in our research at the Dallas Fed shows, is very critical to competitiveness of the United States. And what do I mean by that? 70% of the goods that are imported from Mexico to the United States are what are referred to as intermediate goods, meaning they're goods that go back and forth across the border as part of integrated supply chains and logistical arrangements. And further, 40% of the content of U.S. imports from Mexico is U.S. content.
Right.
So this is a very different trade relationship than, say, the relationship with China, which is primarily or heavily final goods. This relationship has allowed U.S. companies to be more competitive in their manufacturing. It's allowed us to grow jobs in the United States. And if we didn't have this trading relationship, we would likely lose those jobs elsewhere in the world, probably to Asia.
President Kaplan, you know I've got a great team here at Bloomberg helping me out, making me smarter on this Friday. Let me begin with Michael McKee on NAFTA. What does Robert Kaplan need out of new NAFTA negotiations?
Well, as a central banker, I'm going to be careful about not commenting on a specific trade negotiation.
Right. Okay, fair.
Other than to say I'm optimistic. In talking to parties on both sides, I'd be optimistic that the importance of this trading relationship and the fact that it's much more of a strategic supply chain, sophisticated logistical relationship, I think that's being appreciated. And I'm actually optimistic, relatively optimistic and hopeful, and people in Mexico are too, that this agreement will be renegotiated in a successful way.
We just heard testimony from your boss, Chair Yellen, in Washington. Help me with the word transitory. Arjana Smilak is looking at transitory. Rob Kaplan, I've got a definition back to 1374 in Chaucer. I want to know Kaplan's definition of transitory inflation, and is that disinflation, rather, and is that going to end at 8:30 this morning?
Well, there's two parts of this inflation question. Number one, as your viewers know, at 4.4% unemployment and relatively low amount of labor slack, and I look, by the way, at U6, which is the unemployed plus discouraged workers plus people working part-time for economic reasons, and that's still not far away from the pre-recession low. It's 8.6%. At that low level of unemployment, you would historically have seen more inflation pressures. We're not so far. March was weak. April and May were a little stronger, and I believe strongly that some of this is transitory, meaning there's some one-time factors in the March numbers, but I think some of it is not transitory. Technology-enabled disruption, the fact that workers are being replaced by technology, that shoppers can use technology and have much more pricing power. I think businesses have far less pricing power right now than any time in my lifetime. And I think because of that phenomena, as well as to some extent globalization, in that goods and services are being to some extent competed for globally, I think we need to accept that some of this muted inflation is the fact we're in a different kind of economy than we were in 5 years ago, 10 years ago, and 15 years ago.
That's brilliant. That's a Kaplan distinction. Let's go right to that. The pricing power issue. Is this a different pricing power battle than the one that made Jack Welch famous years ago at Generous Electric?
It's dramatically different. And the reason for that is the rate of disruption, and let me explain what disruption is.
Please.
New business models being replaced by more efficient models that are technology enabled. And you go right down the list. The film industry, Kodak and Polaroid being replaced by the digital phone. Retailers being displaced by Amazon. Uber displacing taxis. It goes on and on and on and on.
Right.
And because of that, businesses, even if they have wage pressure, which I think there will be more of a wage pressure in the months ahead, it is much harder for them to pass that on to consumer, because consumers have far more choices, and traditional business models are being supplanted at a rate I haven't seen in my lifetime by new business models that are cheaper and better value for the consumer, and I think that's having a real effect on inflation.
If you're just joining us, Robert Kaplan joining us, Robert Kaplan of the Dallas Fed on Bloomberg Radio, Bloomberg Television, worldwide. Okay, I said Michael. Michael Dell's one of your constituents in Austin, Texas. You say Michael Dell's going to see wage growth. When's he going to see it?
I think we're already, I got to tell you, in my conversations with business leaders throughout the 11th District and throughout the country, and in our surveys, we're already seeing wage pressure for skilled workers, but we're now starting to see more wage pressure for unskilled workers. Companies I talk to talk about the term churn. Workers are leaving, unskilled workers are leaving for higher wages, and they realize they're going to have to pay more to keep those workers. And so I think with a lag, you're going to start to see more wage pressure, I believe, in the months ahead. And we're seeing labor shortages, I should say, across industries, but now increasingly for unskilled workers. And so that makes me think we're going to see more wage pressure.
Robert Kaplan, I think you and John Williams out in San Francisco are acutely attuned to currency dynamics. When you and I were at the Council on Foreign Relations weeks ago, you had beautiful analysis of the timeline of rate movements versus balance sheet movements. Our Carl Riccadonna is focused on the dollar dynamics of unloading that balance sheet. Do we care about currency movements when we finally taper to this and taper to that?
Yes, sure. We certainly, currencies and the dollar strength or weakness is something we watch carefully. Listen, I'm sitting right now in a country that's had enormous currency volatility, and that has spurred inflation here. And the central bank in Mexico has had to raise rates literally 10 times over the last number of months. And so a very weak currency or very volatile currency can have an effect. My own judgment, though, on the balance sheet unwind in the United States, I think we've designed it to be done gradually and in a way that is phased in, that I believe I believe and I expect it will have a minimal impact on the Treasury and mortgage-backed securities markets. But we've designed it that way to be very slow, gradual, so it minimizes the disruption to those markets.
Robert Kaplan, I've never done this. I'm going to do it now with you, and I know you're going to say I don't want to answer that, but you've got to. You are more qualified than anyone in the history of the Federal Reserve System going back to 1917 to talk about leadership and transition. Your classic book, What to Ask the Person in the Mirror, you had a beautiful thing for HBR years ago called The Pledge. Advise our politicians how they get to June of next year with the presumed retirements of Chair Yellen. I know you're going to say we don't know that. Or Vice Chairman Fisher. I know you're going to say we don't know that. In empty governor seats. What's the best practice for the politicians in Washington to get to a good and better Fed in 2019?
So you're right. I won't comment on potential candidates and the prospects of that happening. But I will say that. But I will say this: there are two major qualities I would highlight in a Fed chair, a Fed governor, or even a Fed president. But certainly in a Fed chair. Number one, the person, he or she, must be a respected and expert person that can analyze the economy and have views on monetary policy that are respected. They have to be able to stand on their own 2 feet in that regard and be respected. And the reason that's so critical is the second part of the job, which is they've got to be able to mobilize a consensus, forge a consensus among presidents and governors. And it's much easier to do that if you have interpersonal skills and people skills, but it's much easier to do that if you're respected in your own views. It's much easier to forge a consensus. And I think the next chair needs to have those two qualities. I believe Janet Yellen does have those qualities. And if there's a replacement, the replacement needs to have those qualities.
We have an eclectic Fed. I think of Richard Fisher with his unique work at the Dallas Fed before Robert Kaplan. I think of others over the years, Mr. Warsh and others. We have Mr. Quarles being appointed, and I know you're not going to talk about other names. How crucial is it to have a monetary PhD a la Chair Yellen, a la Bill Dudley, and certainly a la the giant Stanley Fischer? How important is it to have a monetary PhD within that triumvirate of a chairman and two vice chairmen?
I think having very strong, grounded PhD skills, and I'm speaking now as someone who's not a PhD, by the way, as you know. I'm not even an economist. I'm a business person.
Some people would suggest that's an advantage, Robert. Somebody would say that's an advantage, Robert Kaplan. He's flying back from France right now.
Okay. So I would say you need to have some number of people with PhD, strong technical fundamental skills. And then I do think you need some number of people around the table that have a different background, business background, and I think the combination of those two is very, very powerful. And so I won't go so far as to say which seats, which need to have which skills, but I think as long as you've got a mix, and you've got a leader that is good at organizing and orchestrating that mix, I think the Fed should and does work and will work very effectively.
President, one final question, if I may. Is this a fully employed America?
Is this a what? I didn't
fully
catch
employed.
The word.
Is this
Sorry.
a fully employed America?
I'd say it's an America that's getting very close to being fully employed. I mentioned U6 earlier. The pre-recession low was 8.1% in unemployment plus discouraged workers plus people working part-time for economic reasons. I prefer that measure over the headline unemployment rate because I think it's a measure. 8.1% was the pre-recession low. We're at 8.6% right now. That tells me if we're not at full employment, we're moving close to getting at full employment. So I think the Fed is getting very close to meeting its full employment mandate. I'm not sure we're there yet, but I think we're moving toward getting there.
Thank you so much. He's with the Dallas Fed and the Bloomberg Television.
All right, well, that was, of course, Tom Keene speaking
us.
with Dallas Fed President Robert Kaplan. Some really interesting headlines. The temporary, transitory inflation. Some is, some isn't. Obviously, deciding what the answer is going to be critical for what the Fed does next.
Well, and key, particularly given Janet Yellen's testimony, and now we have the CPI numbers about to come out in just a few minutes. So we want to get some reactions now to what we just heard from the Dallas Fed President Kaplan. We're joined from London by Jean Mencen. He is Carmignac Investment Committee member, and by Chief U.S. Economist for Bloomberg Intelligence, Carl Riccadonna here in New York. So, Carl, let me start with you on the point that Alex just made, because it does seem to be key right now. The question is the issue with inflation, we're seeing softer inflation, is it transitory or is it structural? And Mr. Kaplan sort of wants to have it both ways.
I'm going to agree with him and say both, because we certainly have these one-off, idiosyncratic, as the Fed describes it, factors, whether it's cell phone contracts or drug prices. However, if you isolate those components from the details, you still see soft inflation and inflation that's backsliding. So I think the Fed is taking a step back and realizing what they saw in March was not just a one-off event, and that there's a more pervasive problem. And it's very difficult for the Fed to really be able to pound the table and say we are serious about a symmetric focus on 2% inflation if they are accelerating the pace of tightening at the same time that headline and core inflation are moving further away from their target.
So, Jean said, I want to come back to you and ask what this means for an investor, because one of the things that Mr. Kaplan was saying was there's a profound, he said it's a truly profound change in the economy overall going on because of technology and globalization coming together. And one of the things it means is a reduced pricing power on the part of companies. How does that affect you as an investor in choosing where you invest your money?
I could not agree more. I think it's quite interesting to see that on one hand, President Kaplan recognized a kind of structural forces such as globalization and technology disruption, which are maintaining inflation relatively low. But on the other hand, the Fed is still relying on this contentious academic framework, which is Phillips curve, in order to make its monetary policy. So as investors, what we could have actually is to have a kind of continuous, relatively benign monetary policy, which is obviously supporting investing in the financial markets. In this environment where growth is moderate and where interest rates are relatively well anchored at moderate level, definitively growth companies, and we think in particular in the US, the technology sectors stands very well, is definitively a key part of a portfolio construction.
Carl, I want to get to the question that essentially you asked the Dallas Fed President, Robert Kaplan, about the balance sheet. The Fed board, the governor, Leo Perena, to be more precise, specifically, referenced that short-term rates are what matters for the FX channel, and that balance sheet unwind matters for term premiums on longer-dated securities. You don't think that holds true for the balance sheet? They don't seem to have a clue either.
I don't know if it holds true, because this is something that has never been done on a massive scale by a major central bank. So we should have very little faith that the balance sheet runoff will not impact the dollar. If we look at each round of quantitative easing, the dollar weakened during the course of those rounds of QE. I find it very hard to believe that the opposite doesn't occur when you put the switch into reverse, and maybe it won't. but we should not be definitively saying, oh, well, this certainly won't happen, because if we have a strengthening of the dollar, that's going to cause considerable problems for the Fed's agenda, not only as it tightens financial conditions, but also as it drives inflation even further from the Fed's target.
But this goes to the point, Carl, that it seems like the balance sheet reduction is all about economic growth, but somehow rate hikes are about inflation. Does that make sense to you?
Well, the Fed's trying to drive a wedge between the two, which is ironic, because at the time when they were introducing QE, the message was, oh, don't worry, this is the same as interest rate cuts, and we can ascribe a certain amount of QE to being equivalent to a 25 basis points rate cut, and they tried to meld the two together. Now they're trying to drive a wedge between the two and have the balance sheet as the passive strategy and interest rates as the active strategy. But if things go haywire, the balance sheet will be the only strategy, and then it will not be passive anymore. It'll be the active strategy, especially if they have to seriously dial back the number of rate increases.
Carl Riccadonna of Bloomberg Intelligence, thank you very much, sir. We know you've got to run. Thank you very much. Carmignac, Jess John's very own Jean Médecin will be sticking with us too. I find these Jamie Dimon comments on the call absolutely fascinating. Bond trading's ups and downs of the weather. The press shouldn't focus on a bank. They should focus on things critical to America, like infrastructure and tax reform.
Sounds a little Trumpy in there.
It does.
Yes,
it's really strange.
Jamie Dimon
I'm
on the
sorry,
call.
I want to know about your bank.
We'll bring you some highlights from that in just a moment. We're going to focus on what's important to the United States of America, the economy, the United States of America, the economy, and the data that drops right now here in the US. So we get CPI that comes in month on month, 0%, dropping from rising from negative 0.1% previously, just below the estimate of 0.1%. Year on year, coming in at 1.6%, dropping from 1.9%, and below the median estimate of 1.7. Retail sales, let's get to retail sales. Month on month, coming in at negative 0.2% from a revised negative 0.1. So it's a downside surprise on retail sales and a downside surprise on inflation. That is not what you want to see if you're an inflationista over at the Federal Reserve looking to raise rates anytime soon. You can see the market fall out. The dollar index down by about 1/3 of 1% off the back of these numbers, Alex.
Yeah, I should point out, though, that average weekly earnings were up over 1% year on year. That's what's really odd about the data. You did have the month before revised slightly downward, but retail sales weak, inflation lower, and yet earnings are higher. Robert Kaplan pretty much pointed that out.
Maybe they're saving more, but the one thing you know is if it's transitory, it's now transitory for 4 months straight.
Also, we want to see what was weak. I mean, if we're just going to blame it on wireless services, we got a problem.
Yeah, exactly. Those pesky wireless services. Okay, so help us put these latest economic numbers into perspective. We want to go back now to Jean Médecin of Carmignac. Thanks for staying with us, Mr. Médecin. So we've got now 4 months straight of softening inflation data. What does that tell you about the economy? Is this just a temporary thing?
I think it tells us that the American economy is obviously at an aging phase of its economic cycle. So whereas we have still economies around the world, in particular in Europe and in Japan, which are accelerating, obviously the U.S. economy is slowing down gently, but still slowing down. The moderate inflation is obviously something which is going a lot more beyond just the economic momentum. There are some structural forces behind it. It's, again, not necessarily bad for investors because it ensures that we are keeping an environment or relatively moderate level of interest rate, which are very important to support the level of equity market. So if I could paraphrase a very famous central banker, I would say that we are in an environment of rational exuberance.
So rational exuberance there. What's your base case then for the Fed when we wind up having this now fourth month, I should say, of weaker inflation?
For us, we think that what is really important for investors rather than decisions on interest rates hike is actually what is going to happen with the balance sheet. We think that it's a lot more important in particular because there is no textbook for shrinking a balance sheet of this size. And I think that this is where, in terms of investment strategy, we need to be quite cautious on segments of the fixed income space, like in particular credit, where you don't really get the valuation buffer which will help you to weather this kind of normalization.
All right, also joining us is Francis Donald, Manulife Asset Management. Francis, in terms of the weakness in the CPI, did we learn anything? Like, is it all wireless telecom services? I mean, airline fares were actually the biggest hit, down 2.7%.
Well, so that we would categorize that as an idiosyncratic factor. What we really need to focus on here are those core services numbers. That's what's going to be most correlated to the output gap. That's going to be what the Federal Reserve is paying the closest attention to. I think we need to recognize that we're not going to solve the is it transitory or structural question this month. It's going to take a few months to get there.
We've had a few of those, though. Come on, Francis. So here's the question. I've just seen a comment on Twitter that says transitory forever. And thinking about things at the moment, this has been a number of months now. How many months does it have to be before it's a trend?
That's a great question. We'll have 3 more of those prints by September, which is why we see a balance sheet reduction in September and not a rate hike by then, because I don't think we will have solved this puzzle. Those wireless cell phone numbers, that's going to take a year to shake out of the number. But I'd also comment here, there's a difference between idiosyncratic factors, one-offs like that cell phone, and cyclical price declines. We're seeing auto prices decline. We're seeing things like healthcare inflation fall. Those might be more of a cyclical trend as opposed to one-offs. I think we kind of have to add that third category of price deflation in there.
So it comes back to the Fed and what the Fed should do with this information.
Yeah, and one of the most important things that we learned this week is in June, we heard this speech from Janet Yellen in her press conference where she seemed to downplay her concern about inflation. She's reversed that this week, said she's watching it very closely. From my point of view, the inflation numbers are probably not going to derail a Fed hike this year, but it does matter directly into the sequencing of events. What comes first, the balance sheet reduction or the Fed hike? With numbers like this, another disappointment on the core month over month, looks like balance sheet reduction comes first.
And Jean-Med said we focus on inflation, we tend to, about what it will do to the Fed and whether they'll raise rates or how fast they'll raise them. But if you're a company, often inflation has been the route toward increased earnings. What is the danger here that if you really do have, if not deflation, at least really slowing inflation, it may affect earnings down the road?
The reflationary momentum of prices has been obviously very good to our earnings of corporations. And if we are going to have the best year in terms of earnings growth for global equity market this year since more than 5 years, it's down primarily to this kind of reflationary environment. We have to be very careful. We are not back into a deflationary environment. We are much more in a low inflation environment. And in front of this low inflation environment, we have also very subdued wage growth. You know that we had recently numbers in the UK where we have also a record high level of employment and we have a much higher participation rate than in the US. And despite a very strong job market, we see that actually wage growth is slowing down. So for corporations, this is not so much a trend of CPI, which matters, than the relationship between CPI on one hand and wage growth on the other hand. And so far for corporations, the environment remains relatively favorable.
But that brings us to sort of the transitory, non-transitory. We did see weekly earnings actually rise over 1%. Francis, when you look at, say, the Cleveland median CPI, that's supposed to strip out the idiosyncratic factors. It's supposed to strip out the wireless telecom services, but that's been rolling over for a few months now. At what point is this a permanent trend?
Well, all of the alternative measures, things like sticky CPI, have been declining as well. Even the San Fran Fed has a median CPI index where they look at the percentage of items that are rising or decreasing in prices. Now, this one's actually a little bit more motivating. It says we have about 68% of the items that still see prices increasing, about 80% of expenditures out of the CPI that are still increasing. So this suggests that we still have some price momentum. And let's not forget, we are closing the output gap gradually. This is the big structural force that will push inflation a little bit higher over time. We're just in the camp that it's going to stay below 2%. Core inflation has been trending over the last 2 decades at 1.7% average. I don't see that we're going to see material upside here, but I wouldn't get overwhelmed by things like airfare prices, which are clearly not an example of deflationary forces in the economy, but of a sector hit.
You know that people are going to talk about airline prices for the next 3 months.
The Fed chair will too.
One-off. Yeah, exactly.
Transitory.
Those airfare prices.
Transitory forever. Francis Donald, of course, of Manulife Asset Management. Great to have you with us on the programme. Jean Madisano coming out. Yes, John. We'll be sticking with us. If you're just tuning in, the inflation data below expectations, 1.6%, dropping more than forecasts from the previous month. 1.6% is your CPI read year on year, and retail sales drop for a second straight month. Some signs of some lost momentum in the US economy. That's the story in the markets, a weaker dollar. Before we continue to get into that, let's cross over now and get you some headlines outside the business world. Here's Emma Chandra.
Thank you, Jonathan. President Trump and the First Lady are heading back to the US. Earlier today, they attended Bastille Day celebrations in Paris, which also marked 100 years since the United States entered World War I. French President Emmanuel Macron thanked the US for coming to its aid, saying nothing will ever separate us. In the US, Senate Majority Leader Mitch McConnell's latest healthcare bill is almost certainly headed to another rewrite. He still needs to find a way to appease the handful of Republican moderates worried about Medicaid cuts. The bill has already drawn 2 firm no's from Republican senators, leaving McConnell no margin for losing further Republican support if he's to get the 50 votes he needs. 2 Israeli police officers have been killed and a third wounded in an attack by 3 Israeli Arab assailants wielding guns. The attack took place near a sacred site in Jerusalem revered by both Jews and Muslims. The gunmen were shot and killed. And in the UK, for the first time, the British government has conceded, on paper, it will have to pay a bill to leave the European Union. Brexit Secretary David Davis referred to a financial settlement in a statement to Parliament. The exit bill is proving to be one of the most difficult issues for negotiators. Media speculation has put the fee as high as $114 billion. Global news, 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg. Alex.
Thank you so much, Emma. So coming up next week, Blair Efron, Centerview Partners co-founder and partner, will be joining us. Don't miss that conversation. Coming up next week, John.
Looking forward to that. In the here and now, here's the market action for you. The reaction to that economic data in the United States. Futures are unchanged. The real story, the price action elsewhere. Let's take a look at the bond market. The 10-year yields pushing lower by 4 basis points, 231 on a US 10-year. In the FX market, in the G10 space, the dollar down, weaker against every single G10 currency. The euro at 114.38, just off a high for the year. The high for the year, 114.89. From an ugly New York City with some pretty soft economic data, this is Bloomberg.
This is Bloomberg Daybreak. I'm Emma Chandra, and this is the Hewlett-Packard Enterprise Green Room. Coming up later on Bloomberg Markets, Lorenzo Simonelli, GE's oil and gas president and CEO. This is Bloomberg. Now to your Bloomberg Business Flash. AT&T is dialing up organizational changes following its $85 billion acquisition of Time Warner. People familiar with the matter say Randall Stevenson will drop the CEO title he's held for 10 years to become executive chairman. In that role, he'll oversee a pair of CEOs who will independently manage the company's telecommunications and media businesses. There's a changing of the guard at Vanguard. The world's second largest money manager says Chief Executive Officer William McNabb will step down at the end of the year and cede his role to Tim Buckley. Under McNabb, Vanguard more than tripled in size, overseeing $4.4 trillion and the savings of more than 20 million investors. And European car demand rose at a slower pace in June. Fewer selling days in Germany and Brexit-related concerns in the UK weighed on a vehicle market said to be peaking. Industry-wide registrations rose 2.1% from a year earlier. While that marked the strongest June since 2007, it was behind May's 7.7% jump. And that's your Bloomberg Business Flash. Alex.
Thank you so much, Emma. Well, we just got some disappointing CPI numbers out for the month of June, and to me, it's all about oil. So take a look at this chart. You have core CPI and regular CPI. The purple line is core CPI. The yellow line is CPI. The white line is oil prices. It's not a perfect correlation, but it's undeniable as you have weaker prices just sort of moving around here. You see a decline in core as well as overall CPI. So joining us for more is Jason Gamble, Jefferies energy analyst, and still with us is Jean Messin of Carmignac. Jason, this is my thesis that everything in the world has to do with oil, right? What's your prediction for oil prices if inflation in some ways is really going to be dependent on it?
Well, Alex, I think we do get a bit of recovery in oil prices as we move into the back half of the year. It's seasonally a period where we see a pickup in demand. I think we will start to see some inventory draws. And I think the prices have retreated enough that we'll start to see a bit of a slowdown in this relentless pace in the rig buildup in the United States. So I think we get some recovery, but we're obviously at pretty low levels here. And I think any follow-through beyond the back half of the year is going to be dependent upon OPEC taking further action in the market.
Well, the real question, Jason, though, to your thesis is what's the marginal cost of shale? And it seems like every analyst on the street is now lowering that. You have Goldman Sachs, the latest, saying, hey, it was 50, now it's kind of 45. What's your take on it? Like, why are we here at this level now at 48?
So I think it's right that the half-cycle economics, if you're drilling a well in the Permian Basin, are about $45 right now. But that's not the only thing that drives investment in shale. There's also the corporate cash cycle to consider. And E&P companies have to have the money to invest in order to be able to drill these wells. So I think you get some real limitations on the ability to put further rigs to work. That's probably 50-55. That's where these producers can hedge out a level that's comfortable for their corporate cash flow.
John, the story of energy equity is that they are the value trade, but no one seems to want to buy them because of the earnings issues in relationship to oil, in particular big oil, because of potential dividend cuts. What's your take on the sector?
We are actually positive on the U.S. energy companies, the shale-related energy companies. We think that they are in a sweet spot in the sense that they are not just relying on the oil price to grow their earnings, but also obviously on the volume trends coming from increasing production from shale oil in the U.S. Obviously, the sector has been a bit penalized since the start of the year by all the up and downs of the oil price, but we maintain a relatively constructive view on the oil price. We believe that demand is quite robust and that in particular there is a lot of negative perception in the market that shifts like electric cars are going to hit very negatively the oil demand. Electric vehicles, even if you build some very aggressive assumptions, won't make up for the increased oil consumption from boats, aircrafts or even trucks. So we think that from a demand standpoint, the outlook remains actually relatively well supported.
Well, let's pick up on that for a second, Jason, and talk about big oil. That's sort of the bullish case, but on the bearish side, it's their free cash flow. Can they cover their dividends? Their growing debt loads. S&P Global really warned on that, in particular when it comes to, say, Total and Exxon and Chevron. What's your call?
Well, I think that in particular there are companies in the U.S. that have lowered their cost structure sufficiently that they can cover their capital expenditure requirements as well as their dividend down below $45 a barrel. Chevron and Conoco, in our view, really fit that description. So they're companies that can then generate a good level of free cash flow if we get into a period of $50 oil. I want to pick up on a point that John made, that companies need to be able to grow their EPS in a way that's not dependent on oil price. In the case of Chevron, we've got some strong production growth coming through based upon past investments. In the case of Conoco, we've got a very aggressive share repurchase program. So we see good EPS growth potential in both those names.
So Chevron and Conoco, two of your favorites. Which big oil stocks do you need to avoid, Jason?
So we don't have any sell ratings, so I have to be a little bit careful here. But I think you do want to point to those companies that have a hard time covering their dividend and capital expenditure requirements in something less than a $50 price environment. And when I say we don't have any sells, we do have underperform ratings in Europe on Repsol and Statoil for those very reasons. So amongst the U.S. names, we see Occidental Petroleum, for instance, as requiring about $60 per barrel to be able to cover their capital expenditures and their dividend in 2018.
Interesting, and they just raised their quarterly dividend also. All right, great stuff, guys. Jason Gamble of Jefferies and John Mensa of Carmignac. It's still dependent on if, though. That's my thing with oil. It's like if prices get to 50, if we get a recovery. I don't know if I want to invest on if. If you have a Bloomberg terminal, check out TV Go. You can watch us online, click on our charts and graphics, interact with us directly. Just go to TV Go on your terminal. If you miss anything in the show, you can just go back and click on it and rewatch. This is Bloomberg.
From New York City for our viewers worldwide, let's get you up to speed. The economic data comes out in the United States about 21 minutes ago, and it comes in soft. Retail sales down for a second straight month. Transitory, the Fed calls it. Well, inflation forces don't look to be there either. Inflation looking soft as well. If you get to the other screen, here's the story in the bond market. Yields lower now by 5 basis points. We're back through 230 at 229 on a US 10-year. And that softer inflation, softer retail sales theme just pulling the floor away from the dollar. It's a weaker dollar story. The cable rate pushing back towards 130 at 129.99, up by about 0.5%. 114.51 is how we trade on a euro dollar. So it's a weaker dollar story. Treasuries with a strong bid and some weak data here in the United States. That's the story on the eco side. The story on the corporate side, a ton of bank earnings starting to come through on Wall Street. I want to cross over to Bloomberg's Julie Hyman now, who's been listening to the JP Morgan earnings call. And I've got to say, Jules, this one sounded fascinating. Looking at the headlines, how interesting is it?
Well, they've just begun the Q&A portion of the call, and the first question came about the Fed's unwind of its balance sheet. Marianne Lake just answering, saying that the bank is still expecting normalization of the balance sheet to begin in September or December at the latest. She's talking about a shrinking of $1.5 trillion over the next 4 years. She said that doesn't mean a dollar-for-dollar reduction in deposits overall, but she said we could see a $75 billion reduction in deposits over the next 4 years, so it would slow, not stop growth. So talking about the effect not just on her bank, but on banks overall. There was also some interesting commentary that came out of the media call that occurs before the analyst call. Jamie Dimon speaking on that call, he says the media and policymakers should be focused on tax reform, improving education, infrastructure, as well as the opioid crisis. Speaking politically there, as he has tended to do on recent calls and in other recent comments, I do want to talk about as well what is going on with the stock price here this morning, because it is lower, even though overall the company's earnings beat estimates. However, the company's forecast for net interest income is a reduction for the full year. Lake on the call saying that's because of increased cost to service mortgages. She also said there's a lower commercial investment bank net interest income.
Julie Hyman of Bloomberg News, great to have you with us on the programme. David, I thought it was really fascinating that Jamie Dimon comes on the call and he says, who cares about the 2 weeks at the back end of June in terms of big trading? Look at DC.
Yeah, and the traders are trading on the weather, he says.
It's the weather, like the weather. Bond trading is like the weather.
Yeah, but he's a lot of advice for us in the media, so we should take careful notes.
It's like retail. Oh, I didn't sell enough coats because of the weather. Now we didn't make our trading because of the weather.
John Medisan of Carmignac Gestion over in London. Hey, John, is bond trading over at the banks like the weather?
I hope not, but definitively I think what it's showing you is that you get a lot more banks for your bucks by investing in European banks at this stage of the cycle, where there is obviously a lot more opportunities to see credit growth accelerate, or even interest rate to be a tailwind to banks' earnings on this side of the Atlantic than on your side.
It's really interesting to me, John, how quickly people want to bring up their European trades without even being asked. And you've done it with the European banks this time around. When you look at the situation with the European lenders, when you're seeing state aid being introduced this late after the financial crisis, does that fill you with some dread to some extent?
I think we need to be a bit more specific, because obviously the Italian situation has been dealt with a little bit of a time lag, if you want. But when you look, for example, at the situation of Irish banks or Spanish banks, the situation has been dealt a long time ago. And we believe in particular that some of the Irish or Spanish names are quite interesting for investors.
All right, thanks so much, John Medicine of Carmignac. Great to be with you today. And coming up next, David Lefkowitz, UBS equity strategist, will be joining us on inflation, on retail sales, on the Fed, and those bank earnings, John. Yeah, let's get to the market action and get you set up for the cash open. Then 34 minutes away. Futures are flat. S&P 500 futures up by about 0.1%. The price action is really elsewhere. Bond yields grinding lower by 4 or 5 basis points. Let's get to the other board. Treasuries bid yields lower by 6 basis points now, and a weaker dollar off the back of some soft economic data. You're watching Bloomberg.
The US economy shows more signs of lost momentum. Inflation forces fade and retail sales drop for a second month. JP Morgan and Citi kick off earnings season on Wall Street with a beat, but the bond trading comeback looks like it's stalling out. And President Trump is wooed by the pomp and ceremony abroad. At home, Republicans struggle to put together a healthcare bill that they can agree on. From New York City, good morning, and a warm welcome to our viewers worldwide to Bloomberg Daybreak. I'm Jonathan Ferro, alongside David Weston and Alex Steele. 30 minutes away from the opening bell. Let's whip through that market action for you. Futures up about 0.1%. The price action elsewhere. The dollar index at a 2017 low off the back of that weak data. We're down by 0.6% on euro dollar at 114.63. Treasuries with a really strong bid, down by 6 basis points on a yield on a 10-year, 229 on a US 10-year. So that's your big price action. Cross asset, let's get you those movers and some of those banks. Here's Alex Steele.
All right, John. So across the board, the banks are getting hit. Remember, as we have yields moving lower, that's going to affect banks on a macro level. On a micro level, though, it's JP Morgan and Wells Fargo that's getting hit the hardest. For JP Morgan, you wind up having FICC trading was down 19%. Now, its loan growth did happen by about 8% year on year, but their reserves did build because of that. They also cited a higher loss rate in cards. So we really want to know what that means when we hear more on the call. In terms of Wells Fargo now picking up some steam, down over 2%. You did have deposits up by 5%, loans up 1%, net charge-offs were modestly lower. So those metrics seemed relatively positive for the company. And Citigroup faring the best of the lot, just off by 0.4%. They had the best investment banking revenue in 7 years. So that was a huge boon for Citigroup. So a different story when it comes to FICC, when it comes to loan loss reserves. Watching that as we head into the open. Also watching some retail names, Walmart and Ulta, both getting a boost from Goldman Sachs, really upgrading both to buy from neutral. Walmart was cited as the best retailer to handle Amazon, and Ulta said basically the channel checks showing no great changes in trends. So a little bit good news on the margin for those retailers, David, but it's all going to be about banks, all about inflation, and all about the Fed going forward.
Okay, thanks so much, Alex. Well, the big news over the last half hour were those CPI numbers. And if the Fed was looking for some inflation in June to turn things around, it certainly didn't get it. The CPI for the month of June was little changed. This was the focus of Fed Chair Janet Yellen's testimony to Congress earlier this week. And earlier in this program, we talked exclusively with Dallas Fed President Robert Kaplan. He gave us his thoughts on the subject.
March was weak. April and May were a little stronger, and I believe strongly that some of this is transitory, meaning there's some one-time factors in the March numbers, but I think some of it is not transitory.
In fairness, Mr. Kaplan, he didn't have the latest CPI numbers when he was talking about the prior months. Joining us now is David Lefkowitz. He is UBS equity strategist. He's joining us from his office here in New York. And Mr. Lefkowitz, welcome to the program. Good to have you here. Oh, Ira Jersey's here too, I see, from Bloomberg Intelligence. He's U.S. rates strategist. He's in Princeton. So, Ira, I will start with you, our rate strategist. What is the Fed going to do with these latest numbers? This is the 4th month straight where inflation numbers have been softening.
Yeah, it's going to be hard for I think the Federal Reserve to be more hawkish, certainly, than what they've been saying they're going to do. You know, the market right now is not even pricing half a rate hike this year. So any hike by the Fed would be a surprise. It would probably wind up causing rates to go even lower than they have. I mean, we've seen a decent rally in the long end of the Treasury curve today, and if you had a Federal Reserve that hiked, you'd actually be pricing in for a policy mistake, lower inflation, and lower long-term yields.
So David Lefkowitz, this is one of the questions about whether the Fed might make what is called a policy mistake. Do these numbers actually make it less likely that might happen?
Yeah, I think that's exactly right. I think this gives the Fed some room to pause if they need to in terms of their hiking campaign. And I think the most important part about this is that this Fed has demonstrated they are very pragmatic. They're not dogmatic. They want to have the appropriate policy to support the expansion. And when inflation is missing their targets, they're going to take the appropriate action. I think the market is now beginning to recognize that the odds of a policy mistake are lower than maybe some people have been thinking a few weeks ago.
Ira, the word transitory seems to be the ultimate crutch for validating your monetary policy stance. Whether you're the ECB and you don't want to make a move, you talk about inflation ticking higher as transitory, or whether you're the Fed and you do want to make a move, you talk about inflation rolling over as transitory. Talk to me about that word and the importance of it going forward from here.
Yeah, I think we need to start asking some of these central bankers, how do you define transitory? Is transitory a 6-month or is transitory just a couple of months? It used to be when we were thinking about transitory, and the first time that the Federal Reserve used that type of language was back a few years ago when the first quarter was weak in terms of GDP and inflation, and then things bounced back. So back then we started to think, okay, well, it's 3 months, we're looking for a quarter of data, but now we're talking about, at least in terms of inflation, it being a little bit more than a quarter. You've had basically 6 months of relatively weak CPI prints and core CPI prints, and so transitory has to have some finite amount of time. So if we don't get a bounce back when we get the July data a month from now, it's going to be hard to see how they can start calling this transitory and it not being, hey, we're going to be in a 1.5, 1.7% core CPI environment for a while.
You're a rate strategist, and you have been for a long, long time. You join us here at Bloomberg Intelligence. As you look at things at the moment, is the market actually pretty well priced for what they see and the reality of the economic data compared to the reality of the conversation on the Federal Reserve?
Well, certainly the market's not as convinced that the Federal Reserve is going to be able to hike, and I think that this data kind of confirms what the market sentiment has been, which is, hey, interest rates are going to go up a little, not a lot, and it's not going to go up quickly. So I think the market is almost perfectly priced for that.
David, when you take a look at what we're going to see in the reaction of a balance sheet unwind, there seems to be a debate in the community. The Fed's like, it's no big deal. It's not really going to have a big impact. It's rates that's going to have a big impact on the dollar. What's your call for that?
Yeah, I think the market largely has that correct. I do think the balance sheet reduction is going to be very gradual. The pace, don't forget, the pace of this is going to be much slower than the pace that they were using when they were actually buying the securities. And so I think it's going to be pretty much something that runs in the background. That's what the Fed would like it to see. I mean, look, I do think at the end of the day, though, this is a little bit unprecedented. They've never really done this before. So we could see some volatility around this. But it certainly is the Fed's intention that they want this to be something that it runs in the background, doesn't have a big impact on markets. And I think they're structuring it that way. And likely that'll likely be the outcome.
Ira, I want to win $1 million. Like, we all want something. It doesn't mean it's going to actually happen. I just don't see how they can unwind the balance sheet and doesn't affect long-term rates when you wind up seeing or it doesn't affect the dollar either. We wind up seeing what happened to the dollar and long-term rates when they did introduce QE.
Well, I think it's a little bit different because, see, when we have runoff, all that's happening is you have debt maturing. So the debt that's going to mature on the 15th, right, on Monday, is only 1 day in terms of duration and maturity. When they were buying long-term debt. So they're basically selling short-term debt, they're buying long-term debt. So really, when it comes to the rates market, at least, it's really in the hands of the Treasury Department. How does the Treasury Department deal with issuing more bonds to the public, more bonds to investors? And I think that the Treasury Department's going to focus on very short-term debt, so T-bills, 2-year notes, 3-year notes. If they do that, there's probably not a lot of rate market risk. Now, that being said, I do think that the dollar might be impacted somewhat just because of the idea that, hey, we're taking liquidity out of the system, even if it's slower than we thought and maybe slower than some people feared. Nonetheless, you're taking liquidity out, so the dollar will have to be impacted at some level. Whether that's a couple of big figures or many is, I think, certainly up for debate, and we'll see that probably as soon as they announce when they're going to start.
David, when we hear lower for longer, we tend to think that's in terms of rates. Interest rates will be lower for longer. What if inflation is going to be lower for longer? What if the neutral rate really has come down? We heard from Mr. Kaplan that he thought that maybe there were some structural factors, such as technology, such as globalization. What does that do to the equities market? On the one hand, a company can borrow money more cheaply, which is good, get your costs down. On the other hand, what does it do to demand? What does it do to pricing power?
Yeah, I think at the end of the day, if we're talking about lower for longer interest rates and how that affects equities, I think it's a good story. I would say this is sort of the continuation of the Goldilocks environment where we've had durable growth. It hasn't been exceedingly strong growth, but it's been consistent. and no inflation, that means the Fed, or limited inflation, that means the Fed can stay looser for longer. That's more of a Goldilocks environment. Now, that being said, we're not going to have that acceleration in GDP growth maybe that some people had been expecting, especially after the election. But I don't think the markets are priced for an acceleration in GDP growth. I think they're priced for more of a continuation of the status quo, which is around 2% GDP growth, like we've been seeing over the last few years. If we get that outcome, I think that's perfectly fine for equities, and you'll continue to see corporate profits rising, especially as we get more data points confirming that here in the second quarter.
Ira, I just want to wrap something up and nail it down with you. For the rate story at the Federal Reserve, it seems like this economic data, at least for this year, doesn't really count for much because the market had already pushed out that next rate hike to the very back end of this year. So I just wonder what it means for the balance sheet debate. Is the balance sheet debate and balance sheet policy independent of the data, or is it data dependent?
Well, I suspect that they want to do it, and I think that they'll use the excuse that there's been cumulative improvement in the economy and the recovery continues, and that by doing the balance sheet reduction, they can do that instead of hiking, and then they could not hike any time this year. And that's kind of, I think, what the market's starting to tell you is that, look, assuming the debt ceiling is raised, the Fed will start runoff this year. Whether or not they hike again is completely data dependent at this point, and right now the data is just not there for them to hike again this year.
Great stuff. Thank you so much. Bloomberg's Ira Jersey. Good to see you. And David Lefkowitz of UBS. You will be sticking with us. All right, guys, it's time for me to say goodbye. I'm going to be heading down to the New York Stock Exchange in just about an hour. I'll be speaking with Lorenzo Simonelli, GE's oil and gas president and CEO. That merger just got final approval over the last few weeks. It's now trading. That's going to be at 10:30 Eastern. Don't miss it because, you know, oil's cool.
You get in the subway in this in the lovely weather that we've got at the moment.
No, I was told to do a subway, and I'm like, I don't think so. I'm taking a cab. This needs a cab.
Good for you. About 20 minutes away from the open. Futures look a little something like this. Let's whip through it for you very quickly. We are higher by about 1/10% on the S&P 500. Some muted price action for global equities. The real story elsewhere. Get to the bond market. Yields pushing lower, much lower by 6 basis points at 228. And it's a weaker dollar, a stronger pound, a stronger euro, a stronger everything at G10 against a weaker dollar off the back of some soft US data. This is Bloomberg. US banks have officially kicked off their earnings season today, and here with us to go through the numbers is Alison Williams, Bloomberg Intelligence Senior Bank Analyst, and David Lefkowitz, UBS Equity Strategist, who has an overweight in financials and thinks equity markets should be well supported by solid earnings growth. Let's get to the banks very quickly. The pre-market moves are a little bit of a head fake given the big move we've got in the bond market going on at the moment. Yields low, which tend to weigh on the financials. So just look at the numbers in absolute terms and tell me how we did.
So I would say that, you know, overall, I think things were maybe a bit weaker than expected at JP Morgan, especially in terms of the guidance, especially in terms of net interest income. And that sort of ties into your comments about, you know, seeing lower bonds this morning. Core net interest income looks like it's doing well at all of the banks. And so by core net interest income, that means sort of the bread and butter business of lending and taking in deposits, et cetera. However, JP Morgan did talk about sort of a weakness in the investment bank. You know, we also saw FICC trading down basically in line. Citi's trading actually a little bit better, but I think the interest income in those segments may be being a little bit weakish. But core interest income at Wells Fargo and PNC, actually core net interest margin coming in better and improving. The other thing is loan growth coming in a little bit weakish. JP Morgan bringing their guidance down. Wells Fargo's loans coming in a little bit weaker than expected.
Talking of weakish, that was the US data a little bit earlier. I can get you up to speed on the eco data right now. The factory output numbers increased 0.2%. The estimate was a 0.2% rise, so bang in line. Industrial production rising 0.5%. Marginal upside surprise there. The estimate 0.3%. The big move was the data we had in retail sales and the data we had in CPI as well. Soft. That meant bonds went surging, yields went lower. And David Lefkowitz, I just wonder whether the bond market and what's happening with US rates is really going to be the headwind to that conviction call that you've got, that overweight on financials.
Sure. I mean, obviously, the rates environment is a big driver of earnings for the financials. But I think the the data out today doesn't really change the big picture. The big picture is that the output gap is slowly closing in the U.S. We think inflation is going to begin to firm very moderately. The Fed is going to continue to raise rates very moderately, again, looking over the next 12 months or so. And that's a pretty supportive environment for financials. But it's more than just the rate environment. It's about deregulation. We saw the CCAR results a few weeks ago, a better return of capital to shareholders. We think that's going to continue to accelerate. And when you get some new regulators in their seats down in Washington, I think you'll see some of those trends improve further. And so given that outlook and valuations that are pretty reasonable, I think financials can continue to work in this environment.
So, David, right now we're hearing a lot of talk about when there'll be another rate hike. But if you go back a year, 18 months, we heard from bank CEO after bank CEO saying the problem we haven't making as much money as we'd like is we don't have the interest rates up. We've now got 3 increases. 18 months ago, they would have done anything to get 3 increases. Have they gotten the benefit they said they would get out of those? If you look at things like return on equity or price to book, is it showing up in the financials?
It's showing up a little bit, and ROEs have moved up a little bit, but they're still pretty low. I mean, that's really the call here, is that I would say if you look at the ROEs that the banks are currently generating, they're still well below what we think are more normalized levels. Now, some of that is because they have a lot of excess capital, and which we think is going to be returned to shareholders. That would be positive, and some of it is due to the interest rate environment, which we think is going to improve. So I think it's a really good point you're bringing up, is that returns, we think, are below normal in a different environment, an environment that we think we're moving into. Returns should be better, and that's going to be a key driver of earnings growth for these companies going forward.
Alison Williams, so let's talk about the communication and the guidance we've had from these banks. Jamie Dimon on the JP Morgan call a little bit earlier telling the press how to do their job and to focus on DC and reforms and infrastructure, tax reform, and those kind of things.
He's actually doing a good job telling analysts and investors the same thing.
Yes, so guess what? We're not going to do that. We're going to focus on what he didn't want us to focus on, which was bond trading, which he said was like the weather. Is there something in that? Is it out of their control to some extent as to what kind of numbers come through in that division?
So there is. I mean, some of it's obviously going to be market dependent. The capital markets business is cyclical. It is seasonal. We're going to be heading into, second quarter is generally weaker than the first, and now we're heading into an even slower period. So some of that is going to be seasonal, and you do just have to run your business and sort of take advantage of the opportunities where you can, and just a lot of it will be driven by client flow, and that's going to be dependent on what's happening with the Fed, uncertainty and the like. Volatility has been low across businesses, and we are seeing that at the banks this quarter.
Okay, Bloomberg's Alison Williams and David Lefkowitz of UBS. Thank you both very much. Coming up in the 1 o'clock hour today, I'm going to be talking with Wendy Cutler. She's the former U.S. trade negotiator, and Fred Hochberg, who ran the Export-Import Bank. We're going to be talking about trade. Remember trade? That was an issue not so long ago, particularly steel tariffs, the 232 proceeding. Okay, this is Bloomberg.
I am smiling because I think anyone who's following the JP Morgan earnings call is probably smiling too. I want to cross over now to Bloomberg's Julie Hyman, who's been listening to the call with JP Morgan, and Mr. Jamie Dimon making an appearance and making some headlines, Jules.
Yeah, he's getting fired up on this call, still about politics and about policy. He's talking about how, or he did talk about how, he's been traveling the world and he finds it frustrating to listen to what he said, the stupid expletive that Americans have to deal with. He talks about the bureaucracy in the United States. He talked earlier, he said, we've been growing since the Great Recession at 1.5% to 2% in spite of stupidity and political gridlock. So clearly he's frustrated. And as I said before, this is something that he has talked about time and time again, but it does seem as though his frustration is growing with Washington's inability to get things done on tax reform, for example. He also talked about other types of financial regulation, crimps on lending that he says has constrained the bank's lending, although he is, as usual, careful to say it has been negative not just for the bank, but for Americans, everyday Americans as well. So he's, on a bit of a, was on a bit of a rant on the call here, John.
He's lighting things up. Jules, stay with us. I just want to bring Alison Williams into the conversation as well. The line from Jamie. $1 to $2 trillion would have been lent out if the capital rules hadn't kept the banks from doing so. Really? Where's the number from?
Right.
Is the demand going to be there for the loans?
Is that you can make a mathematical argument, right? So if this capital was not trapped in the bank and we were lending, we could make X amount of loans.
If someone was there to borrow it,
right? But I think if we look at some of the categories that have been fastest growing, we've also seen concerns, right? So years ago, it was leveraged lending, and regulators got upset about that. There was a pullback. Commercial real estate is another area that was maybe growing too fast. There's been a pullback. Auto originations, we're seeing Wells pull back in that specific area. Card, we are still seeing the banks sort of going gangbusters there in terms of wanting to make those loans.
But if you take a macro look at it, the corporations have been re-leveraging. Their balance sheets have not been deleveraging. They're re-leveraging. How much more leverage did you want U.S. corporations to take on their balance sheets, Allison?
And I think, too, to your point, a lot of, loan growth has been slowing at the banks, but where we've seen a pickup is the debt capital markets.
Right.
So banks have been accessing those markets. Credit spreads, very tight. Bank customers have been taking advantage of that. But I would say, as we're listening to this call, we talk a lot about earnings and how they've come in versus expectations. I would say for the call, I think analysts and investors were likely expecting to hear some of this from Jamie, but perhaps a little bit more impassioned than some of what we've heard.
Here you go, David. Music to the ears of pretty much every investor. Marianne Lake, the CFO, saying the bank is in the market every day buying a stock.
Well, exactly. At the same time, Jamie Dimon says they'd rather be making loans, right, Julie? He's saying we'd rather be making loans. We don't want to buy back our stock.
Right. He said we'd rather grow organically rather than coming in and doing that. I mean, he seems to be saying that there is this growth, not just for the bank, but in the economy to be unlocked if indeed they get policy help. And so that seems to be where his frustration is coming from.
By the way, it strikes me we should let everybody into the secret. They should go to T-Live. If they go to T-Live, you can watch it on your Bloomberg as it unfolds. It's really pretty entertaining.
It's a fascinating earnings call. And just to wrap things up with you, Jules, have we got any guidance from this bank today? We got the CFO, Marianne Lake, kind of touch on what June was like. How have we come into Q3 off the back of that weak quarter for FICC trading? Well,
there wasn't a lot of talk about FICC trading specifically. There is guidance on some other issues. Net interest income, the forecast for that is for it to grow $4 billion this year. The prior forecast, $4.5 billion. The company said the net charge-off rate should improve to some extent over the balance of the year. So we're getting the sort of other individual businesses outlook. We're not getting, for example, an earnings per share outlook. That's not typically what the bank provides, but we are getting some insight into the other businesses.
Hey, Jules, really appreciate your time. Fantastic insights to a very entertaining call that is pretty significant too. Bloomberg's Julie Hyman and Bloomberg Intelligence's Alison Williams. Thank you very much. And as David said, if you want to follow it all, TLIV Go on the Bloomberg to get that top live blog of the JP Morgan earnings call. The opening bow just up around a corner next on Bloomberg Daybreak. About 4 minutes away. Futures are pretty much unchanged. The story, the price action elsewhere. It's a dollar index at a 2017 low. Some weak data in the United States, both retail sales and inflation. A weaker dollar and a stronger session for Treasuries. 229 on a 10-year. You're watching Bloomberg. From New York City for our viewers worldwide, this is Bloomberg Daybreak. I'm Jonathan Ferro. We are about 22 seconds away from the cash open here in New York City. The opening bell just around the corner. Here's the stage set as follows. The scores. Futures softer on the Dow by about 0.1%. Pretty much dead flat on the S&P 500 as we grind towards a second straight week of gains on the S&P 500. And we come into today's session on the Dow with another record high. If you get to the other screen, here's the price action for you. Soft data in the United States. Disappointing for inflation and retail sales, down for a second month on the retail sales number. That means a weaker dollar story. That print right there is a 2017 low. The dollar weaker against everything in a G10 space. Treasuries with a really solid bid, yields lower by 6 basis points, 229 on a US 10-year. So a lot of moves cross asset, a lot of bank earnings to get through as well. Let's get you your open. 25 seconds in. Here's Abigail Doolittle.
Thanks so much, Jonathan. Well, we're looking at a bit of a mixed open here for the major averages. Very small moves with the Dow down less than 0.1%, the S&P 500 and the Nasdaq up. The S&P 500 ever so slightly. Right now, we're not looking at any records, but the day is young. We are looking at a weekly gain for all three averages, the second week higher in a row. The NASDAQ on pace for its best week since the end of May. Let's take a look at a sector very much in the spotlight this morning, the financials. We have JP Morgan, Citigroup, and Wells Fargo all trading sharply lower, this after reporting second quarter earnings. All three banks beat on both the top and the bottom line. JP Morgan did miss on fixed income, commodity, and currency trading. Perhaps that's weighing on those shares. Wells Fargo also talked about how auto lending is weakening, so that could raise some concerns around the consumer. When we take a look at some of the other banks that are yet to report, including Bank of America, Goldman Sachs, and Morgan Stanley, we see big losses here. Goldman Sachs and Morgan Stanley derive even more of their revenue from trading, so they could be trading down on that JP Morgan FICC miss. But let's keep in mind, yields are down, as you've been talking about, down about 5 basis points on this session, down about 10 basis points on the week, the worst week or biggest drop, I should say, for yields since the middle of April. That, of course, tells us that Haven bonds are rallying. That could be another pressure for the banks. Something else that could be going on. This is G#BTV3936. It's a very long-term chart of the forward price-to-earnings ratio for the financial sector. The long-term average here in yellow, right around 12. We see a big spike higher in 2009 on the recovery out of the financial crisis. Right now, John, we do see that it's starting to move a little bit higher, that of the financial sector, the rotation into the financials that we've been seeing recently. So you could say that these banks were priced to perfection, and perhaps what they delivered just was not enough. Seeing the bit of the pullback that we're seeing, maybe the PE drops back down toward the long-term average, John.
Abigail Doolittle, great work. Thank you very much. So at the open, about 2.5 minutes in, let's bring in a team, shall we? Bloomberg stocks reporter Ollie Rennick, senior editor for our Markets Live blog, Mike Regan, and on the phone, Gerard Cassidy, RBC Capital Markets Managing Director. Gerard, I want to begin with you very quickly and get to these bank stocks and move to the downside, but it's very, very difficult to get a clean read on what's happening with the price action, given what's happening with the rates market and the bond market in general. I want to get to the JP Morgan call with you. You were on it, a big conversation about regulation. What's your takeaway, and what did you ask the CEO, Jamie Dimon?
I think Jamie Dimon spoke very well about what needs to be done from a regulatory and a political standpoint in this country to move the economy higher. Specifically in regulation, he cited, which we agree with, there doesn't need to be major changes in regulation to really offer opportunities for better growth in this country through more lending that the banks could do if they would just tweak some of the regulations. And we expect that to happen with this new administration over the next 12 to 18 months. So that bodes well, I think, for better earnings growth for the banks. I'd also point out that JP Morgan is very well positioned to capture that growth.
I also noticed on the call as well, Gerard, that the CEO, Jamie Dimon, really keen to point out that this wasn't about taking bank standards in the United States below anywhere else. He was keen to emphasize that actually they'd put on extra banking regulations here in the United States above and beyond what Basel had already suggested. Is that the story here in the United States? It's actually about not getting an advantage on the European peers. It's about leveling the playing field.
You defined it very well, and in fact, the expression that was used by the former Federal Reserve board member Tarullo, who set those standards, was he wanted to gold plate the regulatory standards here in the U.S. versus the world. And Dimon pointed that out, that our standards here are stricter and tougher than the Basel standards. So if they do tweak them, such as this supplementary leverage ratio or the liquidity coverage ratio, which are two examples of the gold plating, it would bring them down to where the European banks are to level the playing field.
And then the question, Gerard, is if you took away some of that gold plate, what would actually happen in the marketplace? We saw that Jamie Dimon, in the remarks to the analyst, said, in his conversation with you, said we could lend as much as $1 to $2 trillion more. This is collectively the banks. Are those numbers believable? Where would that money go to? Who would be asking for it? It's one thing to say you can do it. It's another to say that somebody wants it.
That's a very good question, and I think the people that want it, it would be in the mortgage space. Now, we have to be careful, of course. We don't want to ever go back to the standards that we had in 05 and 06, when the subprime mortgage problem was being built up and turned into a disaster. But the mortgage restrictions are very high today on the residential side. The residential housing market needs more help in terms of putting out mortgages and just putting the standards to where they were in the 90s and early 2000s before subprime. That would be the benefit, and that's where a lot of the growth would come from.
So Mike Regan, he said the magic word, subprime. When you start talking about saying we're going to loosen up the mortgage standards, if for some reason I get a chill down my spine. Is that something we really want to do? Is that smart right now?
Well, presumably the banks learned their lesson from the crisis. You know, I noticed the Wells Fargo earnings release very much tightening up their auto lending standards. And this is something they're doing without really facing an acute crisis or any acute pressure from the regulators. It is something they're sort of correcting on their own. All the auto lenders are. So one would hope at least that they would learn their lesson and, you know, keep the risk off.
Ollie, just on fixed income trading revenue, doesn't want us to talk about it very much, says it's by the weather, but let's talk about it anyway. We were expecting it. Are we now expecting it to carry on, rolling over?
Well, I think that's a big part of it because this has obviously been a very key focal point for the banks is whether or not they're going to be able to adapt to all the new environments that exist for markets right now. That's a low volatility environment. It's an environment where people invest through bonds in ETFs, all this type of stuff. So to see that number do what it's doing is very important. I think that overall, when you look at some of the fundamentals here, maybe some of these companies selling off a little bit may not be a big surprise. If we actually jump in my terminal, I've got a chart here looking at the financial stock industry in the white line here versus the spread on the 2 to 10 yields. Basically, what you're looking at here is a huge jump in the market post-election that never really died down. I mean, this is the rally we had post-Trump. Banks then have been pretty much flat to actually a little bit higher. The problem is some of the fundamentals have been rolling over. These earnings estimates for banks have been getting weaker and weaker. You've also had these spreads getting even narrower on the bond curve. So I think that a little bit of a profit taking here when earnings don't exactly fit what investors and analysts want is not a big surprise.
And Gerard, for the big deposit-taking banks, they've had an advantage, which is basically they don't have to pay us anything to have the use of our money. We had Charles Peabody from Compass Point on earlier, and he said he thinks there's going to be something of a rate war going on when it comes to deposits. Listen to what he said.
We're seeing the seeds for a deposit rate war developing. If you look at the non-bank system and you look at the rates being paid there, it's now 1.15 to 1.3%. Goldman Sachs Bank, Synchrony, CIT, it's the non-bank system that is starting to bid up deposit rates, and that's going to feed through to the banking system via the money market funds. So I think the seeds for a rate war are being planted right now.
So, Gerard, do you agree with that? Do you see a possible deposit rate war on the horizon?
I think the key word there is on the horizon. I agree with Charlie that we're going to definitely see higher rates. One of the interesting facts today is that the banking system's loan-to-deposit ratio, which is a measure of leverage, is very low relative to the prior 3 tightening periods. Therefore, the banks don't need to pass on higher deposit rates as rates go higher because they're not forced to support the loans since there aren't as many loans in the system. That being said, with the Federal Reserve's expected unwind that is going to go full speed next year, I would suggest, like Charlie is, we are going to see higher deposit rates in 2018, especially in the second half of the year. Whether it gets into a war or not, that we could debate that, but yes, higher deposit rates are going to be coming, no doubt about it.
Gerard, the jargon's deposit beta, but I wonder whether the history really counts for much, given that we've just gone through 10 years of zero interest rates, and whether the banking model and what consumers are willing to accept has really changed radically. Does the history tell us anything about what we might expect?
That's an interesting observation because we are in uncharted territories, and the banks going into the first couple of rate increases were expecting to have to pass on more of those rate increases to depositors, and they haven't done it. So if you have extra money in a non-interest-bearing checking account, moving it over to a money market fund for 1% may not be that enticing. However, those money market funds may be paying 2% sometime next year, which seems likely. Then it will draw the money out. So I think what we're going to see with betas, they're going to stay lower for longer, but then they're going to move parabolically as rates go higher in the second half of next year.
The inflection point, the second half of next year. Great to have you with us on the programme, Gerard, to break that down. Really fascinating stuff. Gerard Cassidy of RBC Capital Markets. Bloomberg's Ollie Regan alongside Mike Regan. Ollie Rennick alongside Mike Regan. There we go. They'll love that in the commercial break. 10 minutes into the session, let's get you up to speed very quickly. Equities on the front foot on the S&P 500, up about 0.1%. Dead flat on the Dow, though grinding out another record high. It doesn't take much when you close to the record yesterday. If you get to the other screen, here's the price action for you. Yields lower by 5 basis points. 230 on a US 10-year, 130 on cable. It's a weaker dollar story across the G10 space and some weak data here in the United States. Inflation and retail sales disappointing across the board. You're watching Bloomberg.
This is Bloomberg Daybreak. I'm Emma Chandra here in the Hewlett-Packard Enterprise Green Room. Coming up on Bloomberg Markets, Fred Hochberg, the former Export-Import Bank chairman. That's at 1:30 p.m. Eastern Time.
This is Bloomberg. I'm David Weston. Since the election of Donald Trump, the S&P has done very well, up about 14.4%. But the tech sector is up even more, 21.6%. Recently, though, there's been some selling of tech stocks, and some companies have been hit worse than others. Let's talk about Snap, the parent company of Snapchat. It's fallen below its $17 IPO price this week, and it was swiftly downgraded by Morgan Stanley and Cowen, who were both underwriters of the company's IPO, which is pretty cold if you think about it. Joining us now is Bloomberg's Caroline Hyde in London, and here in New York, our colleague Mike Regan. So, the news keeps coming in for Snap. It doesn't seem to be very good, Caroline.
David, exactly right. It's not great when two of your underwriters have now decided to downgrade you in the same week. Morgan Stanley, Cowen now doing it. Both similar reasons, it would seem. We're seeing the likes of concerns on competition. We're seeing concerns about the monetization, really, of its advertising product. That's really what Cowen is putting out, saying, look, there's competition in digital advertising. It's going to take longer to monetize. No wonder, get this, the stock is down more than 40% off of its peak that was hit back in March the 3rd. Meanwhile, the Nasdaq's rallied some 7% in the same amount of time. I also think there's a lot of selling pressure going into the so-called lock-up expiry. This is when those that have been the initial share backers, the initial investors in Snap, the private investors, finally get to cash in. Perhaps not quite at that juicy price point that they hoped.
But lest we give a misimpression, there are some analysts who still have a buy in the stock. Is that correct?
Yeah, there's still some analysts actually who raised the bet to a buy this week, no less. We had Stifel come in just yesterday, David, this is interesting, coming in and saying, look, actually, this worry about July the 30th, the lock-up expiry date, you're overblowing it. There won't be that many more selling on this stock. He also says the competition from Instagram is overdone. He says if you're looking at how the app is faring, the downloads, that's looking pretty nice. And get this is really a bit of a thump out to all the investors there. He's saying, you don't get it. You don't use it. You're trying to equate it to the likes of Twitter, but it's not. It's different. And therefore, that's why you're perhaps got this negative bias. If you look at ANR on the Bloomberg, we're seeing actually overall, it's been pretty steady. The amount of sells have remained at about 5. The amount of buys have remained at about 11. And the bulk of everyone really says, hold it. But meanwhile, that yellow line keeps on tracking lower below the initial IPO price.
Yeah, we're looking at that right now. So I guess the lesson is you have to be less than 22 years old to be an analyst.
Yeah, maybe. I just think that the price target is astronomical still if you're looking at this company. Yeah. There's only 5 sales on it, but because of some of the sales in there are the underwriters, it's got a lot of attention. But the potential upside, according to the analysts, return potential, 32%, apparently, Mike Regan.
Well, it's interesting. Disclosure, my kids are completely addicted to Snap. And I keep reading comments from and hearing comments from, investors and other analysts saying the same thing, saying our kids are on this thing all day. There's some potential there. But obviously, the genius of Facebook was not creating this social network. It was, as Caroline said, it's monetizing all those eyeballs, all the downloads, all the clicks, the stickiness of the app. Snap is a very sticky app because of this streaks thing. Kids want to continue their streak. You know, they tally up how many days in a row you've talked to someone. And for some reason, kids love that. Now, that makes it a very sticky app. Can they monetize it? I don't know. It does remind me a bit of the .com days where we started looking at metrics far away from profitability and sales and things like downloads and eyeballs. The difference, I think, this time is when you see an IPO like Snap, when you see an IPO like Blue Apron, it kind of makes all the other unicorns back off a little bit and say, we're not ready to come into the market just yet. And for the legacy tech companies, that's not the worst news. You don't want this flood of IPOs overwhelming the market with supply of stock.
I always wonder, when you look at a tech company like Snap, how we'll view these companies in 20 years' time. And I imagine in 20 years' time, you'll look back at Facebook as this revolutionary thing, and you'll look back at Snap as people staring on their phones with rainbows falling out their mouths, and you'll wonder what on earth that was all about. Caroline Hyde, the Facebook Snapchat story. Some people very keen to make this comparison between the performance after the IPO and remembering how Facebook really underwhelmed and underperformed. Is there anything in that?
Yeah, I think that's interesting because we did see Facebook take about a year to prove to the market that it was mobile first. And that was what really the big story was for the market. And I think with Snap, the big story is we're not just experimental. We are actually going to be a must-have advertising area for big companies. But as yet, they're yet to prove it. Remember, their daily active users underwhelm the market in their Q1 numbers. Their Q2 numbers come out in August. Will they manage to steady the ship in that respect? At the moment, I'm looking at the shorts out there. A third of the float is currently shorted. So clearly many people worrying about going into Q2, worrying about going into this lockup expiry. But I think also just to Mike's point there, it is interesting that a lot of these startups now, these so-called unicorns, even Uber, look at it, they've now got to show that they can have a bottom line, that they can be profitable, that they can narrow their losses. You can't be a Blue Apron, you can't be a Snap and come in and still not prove profitability, as Twitter did. You need to start to show where the money is coming in. Otherwise, you're just going to keep these companies in the private markets where there's still plenty of liquidity. It's interesting, though, in Germany, Delivery Hero, that stock's still doing pretty well after IPO.
Okay, Caroline Hyde, great to have you with us from London today. And Mike Regan right here in New York, thanks for joining us as well. Now, if you have a Bloomberg terminal, you want to check out TV Go. You can watch us online, click on our charts and graphics, and interact with us directly. Just go to TV Go on your terminal.
About 20 minutes into the session, then, here's the story of the markets for you. Equities on a front foot, the S&P 500 up by 0.2%. The Dow grinding out another all-time high for a third straight session. If you get to the other screen, here's the price action for you. The real price action. Yields lower by 5 basis points at 229. And the dollar just keeps heading south. Sterling north, 130.36, up by 0.75%. The euro grinding higher as well. It's a stronger euro, a stronger pound. But the real theme in the FX market today is a weaker dollar story off the back of some soft retail sales and weak inflation data here in the United States. From New York, for our audience worldwide, this is Bloomberg.
This is Bloomberg. I'm David Weston. Senate Republicans say that they are going to pass a health care bill before they leave for vacation in August. But the initial reaction to their new bill makes that look a lot less than certain. And that's before we get that updated CBO score on the proposal. Coming up soon, I expect. For more on what to expect out of D.C., we turn now to our chief Washington correspondent, Kevin Cirilli, who is at Capitol Hill. So looking at it from New York, it looks sort of nip and tuck at this point.
I think that's a good way to put it because, look, they can only afford to lose 2 Republican votes in the Senate in order to advance this legislation. And already 2 senators have come out against the Senate Majority Leader's updated health care proposal. Senator Susan Collins, a Republican from Maine, as well as Senator Rand Paul, a Republican from Kentucky. Now, one is a centrist, the other, of course, a more conservative member. So then, David, when you look at the list of senators who came out in the Republican Party as being undecided, that's where this gets interesting because the Majority Leader cannot afford to lose one more vote. People like Senator Dean Heller, Lisa Murkowski, Rob Portman, Shelley Moore Capito, all of these folks are a bit more moderate. But take a look at Senator Mike Lee, a Republican from Utah, who really has worked hand in hand with Senator Rand Paul in the past. And so that is why the chances of this, there really is literally no room for error, even after that nonpartisan Congressional Budget Office score gets released early next week. And then to throw all of this into the mix, if it does get out of the Senate and does get through reconciliation, it's anyone's guess whether it will then be voted advanced but the House of Representatives.
At this point, Kevin, as a practical matter, if they pass anything out of the Senate, isn't the House going to have to go along to get something to the president?
So I think that there is increasing pressure on these folks in the House of Representatives, especially in the Freedom Caucus, to actually get on board, especially before the August recess. I can tell you that behind the scenes, working through back channels, the negotiations on tax reform are underway, and they're suggesting to these lawmakers that, hey, if you get on board for this health care, it might not be everything you want, but you'll get a shot to repeal parts of Obamacare, and you will also get leverage in terms of these ongoing tax negotiations.
Kevin Cirilli coming to us from Statutory Hall. Great to talk to you. Thanks, Kevin.
Thanks, David.
Jonathan.
So that's the situation with the politics. Let's get you up to date on a situation with the data. Some soft retail sales numbers, some disappointing inflation numbers as well here in the United States. And earlier, before the data came out, we caught up exclusively with Dallas Fed President Robert Kaplan, who gave us his thoughts on the economy.
March was weak. April and May were a little stronger, and I believe strongly that some of this is transitory, meaning there's some one-time factors in the March numbers, but I think some of it is not transitory.
That was the Dallas Fed President Robert Kaplan in an exclusive interview a little bit earlier on Bloomberg TV. The question of the day, David Weston, that was before the data came out.
That was before, exactly.
Okay, so how many months make a trend, and how long does it have to go on for before it's no longer transitory?
Yeah, exactly. It becomes permanent at some point. You have to ask why it is. But also, you saw the markets reacted right away.
Huge move in the markets, and we can get to that market reaction for you. Bonds with a really solid bid today, yields lower, and a really big move on the dollar too. That's the equity situation. But if you get to the other screen, just look at the action elsewhere. Bonds bid big time. 230, yields lower by 4 basis points. And that weaker dollar story, David, really coming through. And if you're looking for strong US data to validate the move over at the Federal Reserve, you're struggling to find it right now. The easy thing to find is that word transitory, and maybe that validates your move through the next 18 months. I don't know.
But I think Janet Yellen implicitly recognized that transitory only goes so far in her testimony. She started to back off a little bit, saying we are a little confused, let's say, about what's going on with
let's just say the Fed Chair Janet Yellen, 2 days of a semi-annual testimony, and I asked the guest a little bit earlier about conviction, whether she still had conviction. And I didn't sense from her, and I know this is very fluffy and fuzzy and subjective, but you didn't sense from her that she had the conviction about the direction of this economy, and therefore any conviction about her current monetary policy stance.
And if she had the conviction, would you believe her?
No.
Would she be credible at this point?
And maybe it should be Gary Cohn. In the words of President Donald
that's
Trump.
A different
That was the other big story, wasn't it? Of the week.
That was
the other big
right.
story, and I think that was a really fascinating one as well. When you think about who's going to be the next Federal Reserve chairman and whether the words of the Fed chair this week really counted for much. From the whole of the team here in New York, you've been watching Bloomberg TV.